This is Bloomberg Surveillance with Tom Keene and Paul Sweeney.
What do you say to people scared stiff in cash?
We've got an administration, presumably, that will be pro-business, lower taxes.
With Lisa Mateo on markets.
AI affecting demand for cloud computing.
And Michael Barr with news.
U.S. Secretary of State discussed the conflict in Gaza.
The best in economics, finance, investment, and international relations. This is Bloomberg Surveillance on Bloomberg Radio.
Good Thursday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We are streaming live on YouTube as well, so head over to that internet thing, Bloomberg, youtube.com, and search Bloomberg Podcast, and that's where you find us. Tom Keene is off today, and we all wonder what Tom Keene does on a vacation day. We have no idea, but not to worry. Jess Menton filling in for Tom. And Jess, it's great to have you here today because I left the office yesterday, and everything was fine. Then the Fed speaks.
That's
and
right.
And the markets just fall out of bed. We're going to talk to you all morning about what's happening in the markets, what happened yesterday, how the markets are reacting. Coming up today, Janet Rilling. We're going to talk fixed income. She is over there at Allspring Global Investments, talk about the bond market. Christina Hooper, Chief Global Market Strategist at Invesco. She's going to join us as well, and that's a good thing because she gives us a nice global view. Then in studio, got this Michael Kushma guy. He's the CIO, Global Fixed Income at Morgan Stanley Investment Management. Then around 8:15 a.m. Wall Street time this morning, we'll have a simulcast with Bloomberg's David Gura. He's going to be speaking with Secretary of State Anthony Blinken. That's coming up at 8:15 a.m. Wall Street time, and we'll bring that to you. Bloomberg Surveillance this morning brought to you by Oppenheimer. Oppenheimer focuses the power of their thinking on you, creating customized plans to help achieve your goals. Put the power of Oppenheimer thinking into your investing. Call an Oppenheimer professional today. All right, let's kick this whole thing off this morning with Lisa Mateo on a Bloomberg Business Flash. Lisa, what do you have?
Yeah, and we've got futures kind of recovering from the Fed Day hangover. Stocks took a little bit of a hit, after policymakers projected just 2 interest rate cuts for all of 2025. That's half of earlier forecasts, despite cutting its benchmark rate for a third time. So we have NASDAQ futures up 0.3%, 83 points. Dow futures up 0.4%, 186 points. And S&P futures up 0.5% or 30 points. We have the 2-year yield, 4.31%. That's down 3 basis points. The yield on the 10-year, 4.52%, and that is up 1 basis point. Taking a global look, Asia, Bank of Japan kept its monetary policy settings unchanged, but comments from the BOJ governor, it cast some doubt on whether the bank could hike interest rates in January. We have the yen down more than 1%, and now the Bank of England just coming in, voted to keep its benchmark rate at 4.75%. Checking in with the British pound, it's up about 0.2%. The Bloomberg Dollar Spot Index right now, that is little changed. Shares of Micron Technology, the largest U.S. maker of computer memory chips, down 14%, delivered a revenue forecast, missed projections by about $1 billion, and that was due to sluggish demand for smartphones and also its PCs. And home builder Lennar down 10%. Its forecast for new orders in the first quarter, well, that missed estimates. After the close, we're on to FedEx and Nike, and Nike should be interesting. Its CEO Elliott Hill facing his first earnings call since accepting the job in September. That is your Bloomberg Business Flash. Paul and Jess. Have it.
That's totally fine.
All right, Lisa, we appreciate it. Yeah, again, Tom Keene. What do you do with Tom Keene on a Thursday and Friday off? I mean, go figure it.
He's probably anywhere around the world. Where is he?
He's in a cafe somewhere on the Upper East Side having a beverage of his choice, I'm sure, at some point. All right, Lisa Mateo, thank you so much. We got Jess Menton sitting in for Tom. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Jess, I left at noon yesterday. Everything was fine. What happened in the afternoon in your equity markets?
That's right. So if you look at the S&P 500, not only was its worst session since August, since that was the yen carry trade unwinding, but also it was the second worst session that we've seen for the S&P 500 since the actual bull market began for the index in October of 2022, with that decline of close to around 3% there. So you also saw this among other riskiest corners of the market. So if you were looking at the most shorted stocks, also if you were looking at the non-profitable tech, all of those getting hammered. Obviously, we saw big spike in the VIX as well. But it's interesting because usually when you see big spikes like that, you tend to see people come in and buying. And then also on a short-term basis, the older sold conditions, if you're looking at the 10-day moving average as well as 20-day moving average of stocks that are trading above that, it's only about 4% for the 10-day and about 7% for the 20-day. So it's going to be interesting to see how this shapes up because we still have triple witching on Friday. That's going to be one of the biggest that we've seen all year and close to the records with over $6 trillion.
Boy, you weren't kidding with this VIX. I just pop it up because I know Tom Keene likes us to focus on. We got up to almost 28 on the VIX. Just extraordinary. There were 21 right now. All right, let's talk about the bond market here. We can do that today with Janet Rilling. She's head plus fixed income team at Allspring Global Investments. Janet, kind of what's your call here? I mean, we have some positive total returns in the fixed income market in 2024. That's a good thing. What do we do in 2025? Because I don't think my Fed's going to be as dovish as maybe some of us thought earlier.
Yeah, we certainly got a more hawkish outcome from the meeting yesterday. But that said, we are still constructive on fixed income markets as we look at 2025. And it boils down to yield. Yields are attractive in the fixed income market. I mean, we went from a point in January of 2021 where a quarter of the bond market traded at negative yields. And you fast forward to today, and the bucket of 2% or higher yields is almost 90% of the market. So we are at a different point in terms of fixed income markets, and I think that's really attractive. Certainly, there is risk for higher rates. The Fed outcome shows that they're not going to be cutting as quickly as the market had thought. But that extra yield that we're getting today provides some break even for higher rates. So we do think allocations to fixed income make sense in this environment.
When you're looking at the 2-year yield, obviously more policy sensitive to the Federal Reserve, but it's interesting because it's actually converged with where we've seen the Fed funds rate right now. And so is the bond market really trying to tell us that the Fed should stop cutting rates at this point?
I think the bond market is saying needs to go slow. The Fed has said they're data dependent. The market in turn has to be data dependent. And I would say the bond market has been paying attention to the data, and the Fed has adjusted now as well. So, next year, right now, it penciled in 2 more cuts, but that could be off the table, particularly if you think about the fact that the Fed has not been, or at least they've said they're not incorporating tariffs, immigration, deregulation, any of the policy items that are still yet to come.
Janet, as I just look at the performance in year-to-date 2024, boy, the best performance has been like in high yield, leveraged loans. I mean, those are 8-9% total returns this year. How do you think about credit in 2025?
Down in quality has done quite well this year, and I think that's really a reflection of an economy that has surprised to the upside. That resiliency really supports those lower quality credits, but it also means that valuations now are quite rich. And in fact, when we look back over the last couple of decades, we're getting close to the tight levels on valuations. So to us, that really screens for a bit more caution. We still have allocation to places like U.S. high yield, but we're at the lower end of our range because we do worry in the event there is some hiccup in the economy, spreads go wider, or if there's some geopolitical event. On the other hand, we don't think you should have zero allocation because, again, we've seen this year the economy has been surprising to the upside. And as we look forward the next couple of quarters for the economy in the U.S., we see it's likely to continue on a pretty decent growth trajectory.
If you're looking at the 10-year Treasury yield, obviously climbing above 4.5% for the first time since May, and looking at some of these big calls, if you look at T. Rowe Price, they're thinking that the 10-year could actually hit around 6% in 2025. If you look at which banks think it could potentially hit 5%, Franklin Templeton, JP Morgan Asset Management. Where's your view on this? Because typically when you see a big move like that in that typical asset class, you're going to have big moves as well in other asset classes like the stock market.
Well, it's certainly difficult forecasting rates, right? I mean, many have got it wrong over the last 12 months. If you look at since September, we've moved on the 10-year about 100 basis points. We think that range, 100 basis point range, is things we should be thinking about for looking forward to in 2025. Volatility is going to remain as long as the Fed is data dependent, which they said they are. So we think about it a little bit more in a range rather than a point forecast. And I think, reasonable outlook, particularly for the next 6 months, is that range from about 375 to 475. And then I think you can be a bit tactical when you get to either side of the end of that range.
So, Janet, here, did your view or the view of Allspring as a change as it relates to fixed income with the election last month? Did it change anything with it? Now we've got a Republican in the White House. In a month's time, we've got a Republican Congress going to be seated soon. Did you change your outlook at all?
We did on the margin. I mean, we were constructive on the economy going into the end of the year and into 2025. But with the outcome of the election, that reinforced that view for us. I mean, we see policies that will likely help contribute to growth. However, also a higher risk of inflation. So that is our primary risk that we're monitoring in 2025 is will inflation stay grounded here and maybe even move to the target that the Fed has set? Or is it going to be a continued battle and risk of higher inflation prints in 2025? And I think the outcome of the election is what added to that inflation risk.
When you're speaking with your clients, what are their top questions right now?
Well, certainly inflation is top of mind, and that is from the standpoint of understanding what to allocate to fixed income and what might happen to total returns. But valuations are also quite top of mind. I mean, we just talked about high yield, but in investment grade credit, corporate valuations are also quite rich. So then the question is, where do you rotate in your portfolio? So structured product has been an area we've talked about a lot with our clients because it is a favorite area for us. The valuations in something like agency mortgage-backed securities is a little bit more of the middle of the historical range, in stark contrast to corporate credit, which is at the very rich end of the historical range.
Janet, thank you so much for joining us. Appreciate getting a few minutes of your time. Janet Rilling, she's the head of Plus Fixed Income at Allspring and another graduate of the University of Wisconsin in Madison. Again, pound for pound, some of the best money managers I've ever known are in Madison, Wisconsin.
You're not wrong.
It's just amazing. Ann Maletti is kind of the head of that. She's my all-time fave. With our news in New York City, here's John Tucker.
Hi, Paul and Jess, just in time for the holiday rush. Amazon warehouse employees and contract drivers in 4 states have walked off the job this morning. Bloomberg's Jeff Bellinger has more.
The move comes after the Teamsters called on Amazon to recognize its units and come to the bargaining table to negotiate a contract. The union says the company ignored the demands. Amazon says the Teamsters have intentionally misled the public about union efforts at the company and threatened workers. Jeff Bellinger, Bloomberg Radio.
Well, the stopgap spending bill that lawmakers agreed to just this week is now dead. This after President-elect Donald Trump came out against it and threatened to oust fellow Republicans who don't meet his demands. House Majority Leader Steve Scalise says now it's basically back to square one.
Obviously, there's still a lot of negotiations and conversations going on, but there's no minimum agreement.
Majority Leader Scalise spoke after a meeting last night with Vice President-elect J.D. Vance. A Louisiana resident has been hospitalized with bird flu, marking the first severe human case of avian influenza in the U.S. At the same time, California declared a state of emergency to respond to the growing outbreak among dairy cows. And U.S. life expectancy at birth increased to its highest level since the COVID-19 pandemic. It's attributed to a decrease in drug overdose deaths. The death rate decreased by 6%, resulting in life expectancy at birth increasing to 78.4 years from 77.5 years. This according to a report by the National Center for Health Statistics. The decline in overdose death may be tied to a drop in the potency of fentanyl, the synthetic opioid drug that sparked the health emergency. Global news, 24 hours a day, whenever wanted with Bloomberg News Now. I'm John Tucker. This is Bloomberg. Jess and Paul.
All right, John Tucker, thank you so much. We appreciate it. Boy, after that sell-off yesterday, S&P off 2.5%, NASDAQ off 3.5%. Violent sell-offs there on some pretty solid volume. We've got a little bit of a pickup here today with the S&P up about 0.6%. So we'll see how it plays out for the remainder of the morning. We'll have more coming up. This is Bloomberg. Good morning.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. We have futures advancing. This is after big losses for all the major indexes. Yet the Dow closed down for the 10th session in a row, the longest losing streak in more than 50 years. The S&P 500 suffered its biggest Fed's decision day loss since 2001. The Nasdaq was the hardest hit, sliding more than 3.5%. And that sell-off, came after the Fed voted to lower interest rates again by 1/4 point and showed them caution over how fast they can continue to cut. We have Nasdaq futures up 0.5%, 108 points. Dow futures up 0.5%, 216 points, and S&P futures up 34. The 2-year yield 4.32%. That's down 3 basis points. The yield on the 10-year 4.53%, and that's up 1 basis point. To currencies, have to point out the Japanese yen down more than 1% at 156.83 against the dollar, and we have the British pound up 0.2%. Bitcoin right now up about more than 1.5% at just over 102,000, and the Bloomberg Dollar Spot Index is little changed. To earnings we go. CarMax beat quarterly earnings estimates. Its shares are up 8%. And Darden Restaurants, the owner of Ruth's Chris Steakhouse, the Capitol Grill, up 9%. Its full-year sales forecast beat estimates. We're still waiting word from Conagra Brands. That's the maker of Slim Jim, Duncan Hines. They'll be coming up in just a bit. Love those. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That is a Bloomberg Business Flash. Paul and Jess.
All right, Lisa Mateo, thank you so much. We appreciate that. Jess Menton, she's sitting in for Tom Keene here today. Tom's taking a couple of days off here. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio in Midtown Manhattan. We're streaming live on YouTube, so head over to youtube.com, search Bloomberg Podcast, and that's where you'll find us. Boy, yesterday afternoon, really active in the markets here. We got the Fed decision at 2 p.m., the press conference, and I think the best way you could probably characterize it as a hawkish cut. The dot plot suggests they're going to be cutting less in 2025 than maybe the market had anticipated. We had that big sell-off in equities yesterday afternoon. Let's kind of put everything in perspective here. Christina Hooper, Chief Global Market Strategist at Invesco. Christina, what did you make of the Fed's decision yesterday and then the market's reaction to it yesterday afternoon?
Well, so of course we often see a very visceral reaction and then markets think about it and return to a more reasonable, rational approach to what's happened. But clearly what we saw yesterday was an expression of the Fed's dual mandate. Because on the one hand, Chair Powell argued that they needed to cut because they're seeing labor conditions cooling, that they're looser than they were in 2019, hence the cut. But that they're concerned about inflation being stickier, being higher next year. They certainly altered, quite significantly upwardly revised their expectations for core inflation by the end of next year, hence the reduction in expectations for cuts next year. So just juggling that dual mandate. And of course, added in there, of course, was that additional uncertainty created by Trump policies. Now, having said that, if we go back to the November transcript, press conference transcript, what we see is Chair Powell who said, we're not going to assume, we're not going to speculate, we're not going to hypothesize on policies. And yet this time said some members are starting to think about it and add it into their projections. So we got a lot yesterday, and certainly that big reduction in expected rate cuts for next year was a huge surprise. I will say one more thing, Paul, sorry to go on, but we have to keep in mind that dot plots can be wildly inaccurate. Go back to December 2021. The Fed expected less than 100 basis points in hikes for 2022. We ended up with more than 400 basis points. So we have to take this with a grain of salt.
Something else that I've been keeping a close eye on, as well as many others, of course, Paul, is when you're thinking about the Fed's long-run neutral rate. There's a lot of debate of whether or not that's going to be a lot different post-pandemic than it would have been after the housing crisis. So when you're looking at where its estimate was in this last summary of economic projections, it actually was around 3%. So what I'm wondering is, when you're thinking more of the longer term, is this just telling us that maybe the Fed doesn't have really that much more room to potentially cut, because Powell did suggest that they were getting significantly closer to where they thought the neutral rate is?
So I think this is just such an esoteric question, and it's also a moving target. So I think certainly where we stand today, it looks like there is less room to run, but that could easily change as conditions change. We certainly know there is the potential for some policies to be inflationary, at least inflationary in the short term, like tariffs. But tariffs can also cool demand. So if we were to see tariffs implemented and kept for a significant period of time, that could also alter the macroeconomic picture. It could actually suppress growth to a certain degree, and that would cause a rejiggering in some way of the neutral rate, most likely. So I think we just have to recognize that this does change, and this is the best estimate today, but it could easily move around and move lower.
And it's interesting that you say that, because a lot of my sources have been talking about it's hard to have confidence in a lot of those numbers, because obviously we do know that they get updated quarterly, but then also when you have policy uncertainty, especially when you're thinking about what you're mentioning, more tariffs, also do they push up prices? Does that slow down growth? But then on the offset of that, do you have tax cuts and then deregulation that might help set some of those inflationary concerns? And obviously the other question too, what happens with deportations as well as labor supply and what that means for productivity. So how are you talking to your clients about these issues next year?
Well, you just named all the key policies that could be countervailing forces to each other, right? Some could be very positive for the economy, some might not be. And so think of it as something of a potpourri. And to a certain extent, the impact will be dictated by scope and timing of all these different policies. Of course, some can be implemented sooner than others because they can be done by executive order as opposed to the need for congressional consent. So what we're saying is that we have to look at what we know today. That is our base case, is based on what we see today and our expectations based on that. And we have to recognize that there are just swing factors that could alter that base case. And of course, that will be dictated by scope and timing. And so we just have to be prepared, but also recognize that so much of policy doesn't have a dramatic impact, that markets are largely driven by other factors. And what we expect is a reacceleration of the economy next year. That's important to keep in mind as we allocate. And of course, for the longer term, it's about diversification and staying the course. Even if there are short-term reasons to get nervous or causes for a bit of panic, we can't let emotion take over.
Christina, I know you take a global view. What's your thoughts for 2025 outside the United States?
Well, we certainly see significant opportunity outside the United States. Economies don't have to be pristine for there to be opportunity in markets. And I have to stress that. I think there's been such a focus on the U.S. and talk about how the U.S. economy has been the gold standard. And that has been the case to a certain extent and could very well continue. But that doesn't mean there isn't potential elsewhere. So UK equities, there's a lot of attractiveness there. High dividend yields, high buyback yield, very low valuation. And of course, the catalyst could be, we didn't get it today, but the catalyst, one of the catalysts could be a continued easing in 2025. We think that's very likely. It's certainly not going to be at the level of the ECB, but it should be supportive of risk assets. So that's one example. Asia EM, another example. We think there's a lot of opportunity there, and certainly very significant China stimulus should help. And the Fed dollar, and the US dollar, certainly driven up by yesterday's events. I'm not sure that's going to be a very significant headwind going forward. Again, I think this was an outsized, visceral reaction.
All right, Christina, thank you so much for joining us. Always appreciate getting your global perspective. Christina Hooper, she's a Chief Global Market Strategist for Invesco. And again, after that sell-off today, a little bit of a rebound here. Jess, got the S&P up about 0.7%.
That's right, and that was also yesterday with the S&P declining almost 3%. That was its worst Fed day since the emergency meeting we had seen over a weekend in March in 2020. And that following Monday, the S&P 500 was down double digits. So obviously, big moves there in the S&P 500. But interesting to see the rebound we have today.
Yep, absolutely. S&P up 0.7%. The Nasdaq up about the same 0.7%. Looking at yields, the 10-year Treasury, 4 4.53%. We started yesterday at about 4.4%, so a big move higher in yields yesterday afternoon on the back of the Fed decision. WTI crude oil, $70 a barrel. That has kind of been the level for WTI crude oil. We're going to have more coming up. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. We've got futures recovering. This is after the Fed cut interest rates for a third time, pointed to inflation as a challenge for 2025. We have more economic data out today, post-Fed decision. In an hour from now, we'll get a read on third quarter revised GDP and also initial jobless claims, and that's followed by existing home sales at 10 a.m. Wall Street time. We have NASDAQ futures up 0.7%, 152 points. Dow futures up 0.5%, 224 points, and S&P futures up 0.7%, or 41 points. The two-year yield 4.33%, down 2 basis points. The yield on the 10-year 4.54%, and that's up 2 basis points. To commodities, we have Brent crude lower at $73 a barrel, WTI crude at $70 a barrel, and spot gold higher at $2,612 an ounce. The Bloomberg Dollar Spot Index is little changed. Few companies making news. We'll start with Apple. Bloomberg reporting it's close to getting Indonesia to lift its ban on iPhone 16 sales. Now that comes after the country's president gave his approval for for the government to accept a $1 billion investment from the company. And Foxconn in talks with Renault to buy its Nissan shares. That's according to Taiwan's central news agency. And finally, sources saying Volkswagen and labor leaders moving closer to an agreement that would keep its German car plants open. That is your Bloomberg Business Flash. Paul and Jess.
All right, Lisa Mateo, thank you so much. We appreciate that. Jess Menton sitting in for Tom Keene this morning. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. And we're streaming live on YouTube as well, so you can check us out there. I forgot about the economic data coming out today, so I hit Eco Go. Sure enough, Lisa's right. There's a bunch of stuff coming out today. She wasn't lying. GDP, 2.8%. That seems like a... I take that. If I'm the Fed, I'm okay.
Also, the Atlanta Fed GDP Now model, we know it can be volatile, but for the current quarter, for the fourth quarter, obviously that's normally powered by consumer spending because of the holiday quarter. I mean, that's up around 3.2% right now, so it's about the high end of the range for those estimates. So still coming in pretty strong here. All
right, I know Tom Keene's listening, so we got to quote Bitcoin. He's just kind of yelling in my ear here. We got below 100,000 over the past 24 hours, down from that 107,000 kind of peak here. We're back up to 102,000 for those folks that trade crypto, like our next guest, Michael Kushma, CIO, Global Fixed Income, Morgan Stanley Investment Management. Michael, what did you make of the Fed's announcement yesterday, the press conference, and maybe the market's reaction to what we saw yesterday?
Well, I think the market reaction was straightforward, that we've been quite bullish on post-Trump economic outlook. And the Fed was kind of throwing a bit of cold water on that view that we're not going to keep providing interest rate support for financial asset prices going forward. And we have a lot of uncertainty about what's going to happen in 2024 in terms of the economy. And we need to slow down the pace of easing, given all the worries about where is neutral. The economy is clearly growing above trend. The unemployment rate has stabilized. Again, may not stay where it is, but it's stabilized. We need to pull back from this consistent, constant rate cuts. And I think the market was just overextended in terms of positioning and not ready for as aggressive a pullback as it seemed.
Especially when you look at a chart of the upper bound range for the Fed's fund rate and just showing how distant the series is from any kind of center tendency right now. Where do you view where the neutral rate can be? Because that seems to be something that is up for so much debate right now, especially post-pandemic, because it seemed like even right before COVID, it could have been around 2.5%, but even right now in the long run rate, they still have it around 3%, but could be even higher than that.
It is. You look at the Fed has all sorts of models for R-star, the neutral rate, and they're all over the place. Some are as high as almost 2 real interest rates. Some are as low as below 1. What I see is that there's a short run and long-term equilibrium. The U.S. economy is growing very strongly right now, so rates should be higher than normal. If normal's 3, 4 doesn't look too high in that sense. If normal is 2, rates are very high right now still in the long run. But as long as the economy maintains this cyclical strength, meaning maintaining 2.5% to 3% growth, even substantially over 2, you would have to think these inflationary pressures in conjunction with the policies that Trump is bringing to the table. Remember, when Trump first initiated in 2016, the economy was weak, secular stagnation, low inflation. The unemployment rate was low, but there's a lot of room for animal spirits to reignite and CapEx to increase. Now, not so much. The economy is already flourishing in some ways. Again, all the Biden fiscal policy, expansionary policies, that there's less room to really boost the economy further when you're already growing above 2.5%. So in that sense, the inflationary side of the story becomes much more important, and clearly tariffs are front and foremost on that point.
Did you guys at Morgan Stanley Investment Management change your investment outlook in the fixed income business the day after the election back in November?
I would say no. What we're expecting in 2025 was a reasonably strong economy. Inflation was still too high. Yield curve was very flat to still inverted. So the strategy we've been following still seemed the right strategy, and the Trump policies that were likely to be enacted would increase that probably stronger growth, probably a slightly higher inflation, slightly continue a flat yield curve. So the implications didn't seem too radically different than the current state of the economy.
So how do you view the direction of where yields could go more further if you're thinking about the 2-year, the 10-year, and its impact on obviously how to invest in 2025?
Well, I think a lot of it is due to valuation. So the Fed cuts rates in September aggressively, 50 basis points right out of the chute, so to speak, and bond yields have gone straight up since then. And why? Well, I think it's the inflationary consequences, and that has been happening lately. That inflation, the yield curve has been steepening, or long-term yields have been rising faster than reductions of Fed rate cuts. So short rates have not been increasing as fast as long-term rates, suggesting that it's inflationary worries. It's not so much the strength of the economy, also why equities have been weak the last couple of weeks. It's more about the inflationary risk, not so much that, wow, the economy's strong, earnings going to be really strong. No, if inflation's too high, the Fed's going to pull back. And there are some economists out there who are talking about Fed rate hikes next year, not like a high probability, but growing probability.
How much credit risk are you taking in the fixed income business these days?
I would say a normal amount.
Okay.
And that's one of the risks is that I wouldn't say credit markets are expensive, but not overvalued, because fundamentals have been extremely good lately. And the question is, will they stay extremely good? And given what happened yesterday, I think given valuation levels, spreads couldn't tighten much further. But a pullback is probably a buy. So I don't believe Fed's going to hike rates next year. And I do think the economy is going to be strong and inflation is going to stay contained. Inflationary shocks from tariffs will probably dissipate over time. It's more of a price level shock than a permanent inflation shock. So that any material spread widening is probably a buy.
How exactly do you think policy changes, because we talk so much about this, if you're thinking about trade, tax, immigration, regulation next year, change the inflation forecast and the risks around it? And what do you think the bond market is telling us about that at this point?
It's telling us that there's not a lot of room to maneuver when the unemployment rate is hovering around 4%, give or take a little bit. And obviously there's a lot of noise in labor markets these days. It's very difficult to discern what the true underlying trend is. There's been a lot of hiring. Maybe hiring should be slowing down going forward. And if the labor supply diminishes because of deportations and less immigration, the unemployment rate could go back down again over the next couple of years, even if labor demand is relatively modest. So there's a lot of worries, and I think all the Fed's done is tilting toward the inflation situation's got a little bit worse than it was before. The labor market's stabilized, so what we said in September is now flipped a bit, in the sense that inflation risk is at the margin a little more dangerous than risk of higher unemployment in the short term. But as we know, everyone's forecast for the following year has turned out to be pretty much the consensus view is wildly wrong year after year after year. So what we know for sure in 2025 is we're going to be surprised about something.
The best performance in 2024 has been the high yield, the leverage loan business. And all year people have been telling me spreads are tight, spreads are tight, spreads are tight. But boy, that's still performed.
When fundamentals are good, and absolute yields are very attractive. So, the loan market gives you 8% plus yields in a world where the economy is strong. Defaults are stable. They're around in various pockets, but they're not systematic across the market. Why wouldn't you take 8% yields without taking a lot of interest rate risk at a time when the Fed is very uncertain as what they're going to do next year?
Leverage loans, high yield, boy, 8-9% total returns. That's something you can hang your hat on. I pay those folks this year. Michael Cushman, thank you so much. We appreciate it. Michael Cushman, he's the CIO, Global Fixed Income, Morgan Stanley Investment Management. So there you go. You made some money in your fixed income portfolio this year.
I know. And just looking at the direction of yields here, looking at the 10-year trading above 4.5% once again.
Yep. So looking at the futures here, S&P, we're up about 0.6%. That's nothing to sneeze at. Again, big sell-off yesterday in the S&P, off about 2.5%. The NASDAQ off about 3.5%. We got the NASDAQ kind of bouncing back a little bit here this morning, up 143 points. That's 0.6% of 1%. And I'm going to call it out. Again, Bitcoin, I'm calling it out, folks. Tom's not here. We're up 1%, 102,000 on the Bitcoin. But again, it sold off below that $100,000 level, and that kind of gets your attention. And the VIX, again, Tom Keene, we're sitting the VIX right at 20. That's kind of the level. Above 20, you get a smidge nervous. Below 20 feels a little bit more comfortable. We're down almost 7 points off of the peak from yesterday. With our news in New York City, here's Mr. John Tucker.
All right, guys. The risk of a government shutdown just got a lot more real in Washington. President-elect Donald Trump has come out against that stopgap spending bill that lawmakers agreed to just this week. Vice President-elect J.D. Vance was on Capitol Hill last night to kick off new negotiations with fellow Republicans.
We had a productive conversation. I'm not going to say anything else more about it tonight because we're in the middle of these negotiations, but I think we'll be able to solve some problems here, and we'll keep working on it.
J.D. Vance and President-elect Trump say they want a clean bill that doesn't include add-ons like disaster relief, farm aid, and child care funds. House Minority Leader Hakeem Jeffries says a deal is a deal.
House Republicans will now own any harm that is visited upon the American people that results from a government shutdown or worse.
Minority Leader Jeffries' comments were echoed by a White House statement saying Republicans should keep their word. Amazon warehouse employees and contract drivers in 4 states walked off the job this morning ahead of the holiday delivery rush. The International Brotherhood of Teamsters, Randy Corrigan, says Amazon refuses to recognize its members.
They claim that those contractors, the so-called contractors that deliver for them, those drivers, that they're not their employees, yet they have an Amazon van. They have the Amazon uniform.
Groups of workers at 7 locations in California, New York, Illinois, and Georgia are on strike. Teamsters local unions have put up picket lines at hundreds of Amazon facilities. You know, with all the recent sightings, the FAA has now put up a video. It says will help people better identify drones.
Okay.
Small airplanes typically have red and green wingtip lights, along with white strobe lights and a flashing red beacon.
This is like tailor-made for you. Video. It explains how all aircraft, including drones, they're supposed to have certain lights. The FAA says the drones are required to have a strobe light visible for at least 3 miles. Several federal agencies say in a joint statement there's no national security threat at this time regarding the recent drone sightings. They did confirm some drones have been seen flying near over military installations.
Yeah, that gets your attention. I mean,
I have one in the closet. I haven't used it in years, but I'm really tempted to just
my oldest son has been into drones since he was a teenager, but Flight Radar 24, that's the app I have. You can kind of monitor.
But can you spot drones?
I don't know. I'll test it out this
Flight
weekend.
Radar app I highly recommend because you can, there's a function on it in which you can take the cockpit view in real time of an aircraft, coming in.
I turned Tom Keene onto this.
It's very cool.
He sits out on the patio of the Upper East Side penthouse.
Maybe that's what he's doing now.
And looks at Newark Airport approach.
Now, from my deck, I can see the approach and departures from
you get
Kennedy,
it right there.
from LaGuardia, and from Newark. So I get it all.
You're right there.
Haven't seen any drones, though.
I haven't seen any drones either. I don't know. I don't know. All right, so this whole government shutdown thing, I like to consider myself a engaged citizen, but Friday night, the reality is, it's pizza and beer night at the Squan Tavern. I could care less what the government's doing.
Squan Tavern?
Yeah, down in Manasquan. It's just the best.
I highly recommend it.
I mean, am I going to be paying attention? I'm going to be watching the Knick game or the Ranger game.
Right.
I mean,
I feel like this is one of those things. There's always noise.
Yeah, I guess
it's always noise.
But don't they always come to a resolution?
Most of the time, because a few years ago we had to do this around Christmas time too during COVID, and then it kind of was a last minute thing, and they ended up passing stuff.
Yeah, I don't know, guys. We pay you to do a job. Just kind of get it done.
I suspect that 5 p.m. Friday, most of America is going to completely tune this out.
Yeah, I think
absolutely.
I think you're right.
Getting ready for the holidays.
Nathan's down in Washington, D.C. He'll fix it all. I mean, that's how I figure it's going to all work. S&P 500 futures, we're up 44 points. That's 0.7%. The Nasdaq's also trading higher here. Again, off of that pretty severe sell-off yesterday afternoon after the Fed's hawkish cut is kind of what the smart people are saying. We'll have more coming up. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. We've got futures pointing to a higher open, and this is as traders pricing a strong chance that the Fed will only deliver one 25 basis point cut next year after the central bank's hawkish pivot. Right now, we have the Nasdaq futures up 0.7%, 161 points. Dow futures 0.6%, 271 points, and S&P futures rising 0.7%, 46 points. We have the 2-year yield at 4.32%. That's down 3 basis points. The yield on the 10-year 4.53%, and that's up 1 basis point. To currencies, want to start with the Japanese yen. This is after the BOJ governor cast some doubt on hopes for a January rate hike. Right now, the Japanese yen down more than 1% at 156.95 against the dollar. The pound, the British pound, that's up about 0.3%. That's after the BOE said it's going to keep easing rates gradually in 2025, and the Bloomberg Dollar Spot Index is little changed. Now, after taking a hit following words from the Fed, Bitcoin back on the rise. It is up above 102,000. That's after falling below 100,000 yesterday. But what's also on the mend, crypto buying company MicroStrategy. It fell 10% yesterday. It's now up 4%. And the same for crypto-related stocks like Coinbase, which is now up more than 3%. And even Tesla rebounding post-Fed. Yesterday, shares slid 8%. This morning, shares are on the mend up about 3%. That is your Bloomberg Business Flash. Paul and Jess.
Lisa Mateo, thank you so much. We appreciate that. Jess Menton sitting in for Tom Keene. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. Is MicroStrategy now just, is it like almost like a Bitcoin ETF now? It seems like.
Well, I feel like when we look at, say, how that's trading Coinbase, Riot platforms, I know those are all names that Tom Keene would never want to hear in his studio, but those are, some of the gauges when we want to think of those crypto kind of link type currencies, obviously related to how Bitcoin and other currencies are performing, Paul. MicroStrategy,
MSTR is the ticker. It's got an $85 billion market cap. It is up this year, guess what? 453% this year. Just extraordinary. I don't know why they're not, it's just, this guy's got to be on Rich Go.
Yeah. No,
right
also
quick.
something to point out, too, because earlier this month we learned that it's also going to be included in the NASDAQ 100 now, so after this record-breaking rally.
Yep, and David Gurr spoke to Michael Saylor yesterday, so that was pretty cool. You can go check that out on Bloomberg.com.
Now, a look at the front pages. What's making news around the world? Your daily roundup of today's headlines from major publications.
All right, folks, your daily look at the front pages around the world is brought to you by IBKR. Financial advisors, switch to Interactive Brokers for lowest cost global trading and turnkey custody solutions. No ticket charges and no conflicts of your interest at ibkr.com/RIA. With our newspapers in New York City, Lisa Mateo. Lisa, what do you got for us?
All right, since you love drones so much, Paul, I'm going to start there. I'm starting there. This is in Business Insider. With all these mysterious sightings, Wing and DoorDash are actually launching delivery drones from malls. This is happening over in Texas. Wing.
Oh, boy. Here we go.
Here we go, Jess. Because there are actually sightings in Texas, too.
Okay.
So now with this whole launch, deliveries can be made in those little 15 minutes from some of your favorite stores in the malls there. This is in I think it's the Dallas-Fort Worth area. But it's making these commercial deliveries worldwide since 2019. But now with everything going on, it's kind of like, wow, is this like bad timing? But they can fly. They're pretty quick, 65 miles an hour, about 150 feet up in the air. But yeah, the reports keep coming in about all the drones. We hear John Tucker talking about it all the time.
But won't there be more and more and more drones, right? I mean, are we going to see more and more of these things? If Amazon and some of these,
right,
they start popping these things up in the air.
I mean, it kind of makes sense. So, but are y'all big on Wing in DoorDash at all? Do y'all use
no.
it?
Not the DoorDash.
Yeah, look on Paul's face. He's like, no.
And again, we've already had this discussion, but my youngest actually put a DoorDash or something on my credit card, and that stopped right away.
Oh no!
Yeah,
Shut it down.
Get out of get off your bed and go out and pick up your McDonald's.
The Sweeney offspring, though, cut off.
Although he's in Paris right now, so that's another whole thing. I should live his life. What else you got?
He's doing pretty good. Do you guys have those rewards cards, right?
Yep.
Now, do you use the rewards?
I do.
Do you use them for hotels or do you use them for cashback or gift cards?
Hotels and airfare.
Yeah.
So you do? Okay.
Yes. So
I definitely
cash
especially
them in.
airfare. I use it a lot.
Yes.
I was actually in New Orleans last week, so I definitely used some of that for that too.
Oh,
yeah.
you did. See,
Yeah.
okay, so that's the thing. So this is interesting because this is a bank rate study. It says almost 1 in 4 rewards card holders don't redeem their rewards by the year. They say they're missing out on the free money. That's if you pay, in full every month.
Right.
But the problem is that if you don't use them, they lose value because of inflation, program changes, things like that. And then you have on the flip side, 3 in 5, 61% use their rewards for cash back. So they like the cash back better.
You can get cash back from, you can redeem points for cash?
Yeah, cash back or gift cards.
I do have that cash back on one of my cards. So that's
I feel like
pile that money into some of my retirement.
I listen to my kids, and they're very aggressively manage their points, which I never did.
Yeah. Well, also, I feel like it's because of the way I can see it in the apps for the banking apps and the credit card apps. So I can just every day I'm like, all right, this is what I'm going to do with that money.
But a lot of my friends use it, especially at holiday time, to get all gift cards for everybody.
Yes, that's a good idea. Maybe I'll think about that.
Yeah. See, you got to think about that next year.
The wheels are spinning for Paul, right? His kids, he knows what he's getting his kids.
Stocking stuffers done.
They got a pat on the back for Christmas. All right, New York Post.
Yeah, this was in the Post. So retail thefts, they're continuing to climb, but the problem is that they're getting a little bit more violent. This study was out. Yeah, the National Retail Federation came out with their Impact of Retail Theft and Violence 2024. The average number of shoplifting incidents jumped 93% in 2023. That was compared to pre-pandemic. Monetary losses for retailers risen 90%. And this is despite different efforts, right? You heard of them locking up their different items, right? You've heard of a number of states kind of updating laws to prosecute organized retail crime as felonies. But the NRF vice president telling Fox that a big part of it is because of the organized retail crime groups, and that's why it's getting bigger. But also, it's getting more violent, aggressive. Stores are trying to increase protection for their workers, for customers too, on the same time. Remember, we heard the body cam story about Wal-Mart workers wearing body cams, even TJ Maxx, workers having to wear body cams. So it's an interesting topic, but it's starting to get a little bit worse now.
Yeah, I don't know. I mean, it's just I just noticed from the local retailers here around our office, like the CVS or the
I was about to say
Walgreens,
that they lock up everything.
Everything,
right?
Like toothbrush.
So I find myself having to order a lot more things online because then I know, even just trying to track somebody down to try to open it up, I'm like, okay, it's going to take me a half hour.
No,
so
that's a good point. That might push more people to shop online.
Yeah, I didn't think about that. But I guess they have to hire security, I guess. I don't know.
Right, and that's security. So they're investing, even employee training, teaching them how to handle workplace violence. It's crazy how things are getting. So here's a new side hustle for you if you live in Utah and you happen to look like Jesus.
Nice segue.
Yeah. The Wall Street Journal.
Yes, this is from the Journal. Apparently, a growing number of people in the state want Jesus in their pictures. So hiring lookalikes. They're doing it for family portraits, for wedding announcements, for, yes, the Christmas cards, of course. But how much do they charge? You can make $100 to $200 an hour if you look the part, and families, couples, they're doing it. They're going throughout different locations in Utah, taking these pictures. The funny part is that there are some tips from professional photographers who say, if you're doing this with your kids, just keep in mind, if they don't like taking pictures on Santa's lap, they're not going to like sitting on Jesus' lap. And just the interesting one that I found is that finding a model can be tough in Utah because they have high concentrations of Mormons where the men actually have to keep their hair short and they have to shave all the time. So finding someone with the long hair and the beard is kind of tough. But if you do have it, you can make some extra money.
Okay, so if you're part of the Church of Latter-day Saints, which is one of the state's largest employers, you're required to shave every day and keep their hair short. Okay, didn't know that. Good for that. So that's tough for the Jesus look, right? Doesn't he have longer hair and a beard?
You have to do the long hair and the beard.
Okay.
But apparently it's going to be a thing, and people are saying, like, when they post pictures, people are always asking, "Hey, where did you get this guy?" Like, and so then that's word of mouth.
Gosh, I can see that blowing up on Instagram and social media.
Yeah, this one guy said he's been doing it for like a couple years now. It's just how he makes
Good
it.
side hustle. Yes.
Remember a year ago when I was officiating weddings and y'all were giving me a hard time about that? Y'all thought it was a side hustle. I was just doing it for friends, but here's another option for people.
See, I know.
People can do it. All right, very good. That is our newspaper segment with Lisa Mateo. Thank you so much. We appreciate that. So we got a little bit of a bounce back here in the markets here. I'm looking at the S&P up about 45 points. That's 0.7%. The NASDAQ up about 0.7 as well. We'll see if that holds here this morning.
That's right.
But that would have been a nice little bounce back from a, pretty sizable sell-off yesterday. So we'll keep an eye on those. We'll get this market open for you in a couple hours time, about an hour and a half. We'll have more coming up. This is Bloomberg Good Morning.
This is Bloomberg Surveillance with Tom Keene and Paul Sweeney.
I'm sorry, it's a boom economy, and that's what we're adjusting to.
Neither party seems to want to take on deficits at all.
With Lisa Mateo on markets.
Stocks are coming off of another record high.
And Michael Barr with news.
Tensions between the U.S. and China have heated up even more.
The best in economics, finance, investment, and international relations. This is Bloomberg Surveillance on Bloomberg Radio.
All right, coming up in this hour, strong hour, I'll say, for the 8 o'clock hour. Joe Davis, we're going to start off strong. Chief Economist at Vanguard. He's going to talk about his outlook for 2025 from an economic perspective. At some point this hour, we're also going to have a simulcast with Bloomberg Television. Bloomberg's David Gurr is going to sit down with Secretary of State Antony Blinken. We'll bring that to you as well. Wendy Schiller, professor at Brown University, will get her thoughts on this whole government funding thing. Are we going to have a government shutdown, and how does that play out? In studio, second day in a row. How cool is this? Danielle DiMartino Booth, CEO at QI Research, one of the smartest voices out there on the Federal Reserve. We get her reaction to yesterday's Fed. So a lot coming up in the next hour. Let's kick it all off with Lisa Mateo and a Bloomberg Business Flash.
You got it. We got futures recovering. This is the day after the Fed announcement. Stocks really took a hit after policymakers projected just 2 interest rate cuts for 2025, half of earlier forecasts, and that was despite cutting its benchmark rate for a third time. We have NASDAQ futures up 0.8%, 173 points. Dow futures up 0.7%, 299 points, and S&P futures up 0.8%, or 50 points. The 2-year yield 4.31%, down 4 basis points. The yield on the 10-year 4.53%, and that's up 1 basis point. Monetary policy just not news here in the U.S. We also have the Bank of England kept its rates unchanged. We have the pound, British pound up 0.3%. We have Europe stock 600 down more than 1%. In Asia, the Bank of Japan kept its setting unchanged. But here's the thing, comments by the BOJ governor kind of squashing hopes on whether the bank could hike interest rates in January. So we have the yen down more than 1% at 156.84 against the dollar. And the Bloomberg Dollar Spot Index little changed. Shares of Micron Technology still lower, down 12%, delivered a revenue forecast, missed projections by about $1 billion. Then you have home builder Lennar down 8%. Its forecast for new orders in the first quarter missed estimates. After the close, we move on to FedEx and Nike. That is your Bloomberg Business Flash. Paul and Jess.
Hi, Lisa Mateo. Thank you so much. We appreciate that. Jess Menton sitting in for Tom Keene. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube. Bloomberg Surveillance this morning is brought to you by CohnReznick Advisory, Assurance, Tax. Discover optimization strategies that are helping CFOs make their finance function more competitive and resilient. Talk to CohnReznick's advisors today. Let's check in with Joe Davis, Chief Economist at Vanguard. That's pretty good. But the peak of his career, he really peaked at Duke University, and he got his master's and his PhD at my Duke. So, Joe Davis.
You're on the board, no?
Yeah, still. I'm one more meeting. One
more meeting.
12 years. Hey, Joe, thanks for joining us here. Hey, we heard from the Fed yesterday, Joe. What did you take away from kind of the statement from the Federal Reserve and maybe some of the comments from Fed Chairman Jay Powell?
Well, I think it's been an evolution at the Fed. And, in some ways, I've sounded like a broken record for 2 years. The Federal Reserve is not as restrictive as they think. There's a lot of positive momentum in the economy. We have seen inflation come down and the labor market cool, but GDP growth is 3%. That was the same rate as the beginning of the year. And so I think they're starting to realize that this so-called soft landing is not as much being driven by a slowdown in demand as they thought. And so that means they shouldn't be racing to cut rates as quickly as they were.
In this type of scenario, it's really hard to go back in history when you have a once-in-a-century pandemic and economy coming out of this. So how do you talk to your clients about this and what your estimates are for growth? Because it seems like when you think back right before COVID and the Fed had been raising rates but then had to cut them, it was thought that the neutral rate would be around 2.5% and the economy was weakening at that point. But then now you've had rates above 4% for a couple of years and the economy has remained strong.
Well, and again, I think that's, we spent a lot of time 2 or 3 years ago trying to get a handle on a really tough question, which is that where should interest rates be over the next 2, 3, 4, 5 years? And we came to the conclusion 2 years ago, I think before some perhaps in the Federal Reserve, that the neutral rate or the long-term interest rate was going to be higher and it was not going to derail the economy. Fiscal deficit and deficit spending and government spending has pushed up that neutral rate even more so than growth. And I think what we're seeing in the economy would be consistent with that conclusion. The economy has not rolled over despite several years of so-called restrictive policy. Again, to be clear, I think the Federal Reserve is restrictive. They're trying to ease that somewhat. But I think you have to acknowledge that the neutral rate is higher given the body of evidence coming in over the past year.
What's the inflation risk for 2025 for you, Joe? I think some people read into the commentary yesterday and the dot plot yesterday that this Fed maybe has a higher concern about inflation kind of reappearing next year. How do you think about it?
Well, I think it has been, stickier. I mean, certainly we've seen material progress versus 2 or 3 years ago. And I think we'll continue the inflation, go down more than it will go up. But I think it's giving them pause. I think there's 3 indicators you look at. 2 of the 3 do not argue for further easing. Inflation would be one, and GDP growth would be other. The labor market has cooled more significantly, and that would suggest perhaps further easing in the months ahead. So I think that's what we heard yesterday from Chairman Powell and the Federal Reserve, is they're trying to balance all those mosaic of indicators. But inflation, I think, has been a little bit more stubborn than they would have expected.
It's interesting, too, when you think about the dissents. So there was at least one, obviously, that we saw yesterday. And then also there could be this situation where you had the last time we had at least 2 dissents was in September of 2020 there. And obviously we had Mickey Bowman back in September that did that. So how do you view kind of when you're looking at the cohort of Fed officials in the Federal Reserve and kind of the debate moving forward and how this can be tricky as you were talking about the economy evolving here?
Well, again, I think that's just an indication that we're getting into at least the range or the zone where we're going to see more of a stabilization in policy, perhaps. And I think we saw adjustments to financial markets. They were perhaps expecting a little bit more. I don't think we're finished the easing cycle, but I think what we're seeing, if we're right in our view for 2025, then we'll see more of these debates, which is not necessarily a bad thing. It can be healthy because I think some, perhaps on the Federal Reserve, are looking at some of those indicators I mentioned, and others are weighting others more heavily. And of course, we're all going to have to see how the data evolve over the next 6 months.
Is U.S. global exceptionalism from an economic perspective, Joe, is that still a thing? How do you think about the U.S. economy versus maybe some of our big trading partners out there?
Well, and again, it was really a big theme for our outlook this year is to even assess what happened last year. That's important for going into 2025. And we believe, 2 forces, what economists call the supply side, but it's really simply labor supply, productivity from workers and businesses, had a strong lift. And that explains the exceptionalism in the U.S., meaning higher growth than expected, and yet inflation still, on average, came down. We didn't see that dynamic in any other country, and explains why if there has been a soft landing, it has more to do with those factors I just mentioned than Federal Reserve policy.
Moving forward, when you're thinking about the estimates for growth, as well as when you think about the Fed's preferred measure for PCE, core inflation there, where do you see that moving forward? Because it's interesting when you think about the dynamic between the spread between PPI as well as CPI. Oh. We've seen it be a bit more stubborn, especially in PPI prices, because those can be a forward indicator when you're thinking about consumer prices, and especially what that means when you think about stock prices and margins and what that means for stock prices moving forward.
Sure. I mean, again, our expectation still is that we'll have inflation. We'll be sticky in the first half of the year, but we'll still make some modest progress. Again, we are getting into the range of what some would argue is price stability. I mean, it's on the higher end for sure, but there's still been material progress. I think, again, we're going to have trade uncertainty here, and we could see some movement in the headline with certain tariffs if they're implemented. But that would be a push, I think, because it could also dent growth a little bit. So I think actually the wild card in 2025 is on the growth side, less so than in the inflation side, unless the Federal Reserve would really cut aggressively in the face of high growth, which, again, hearing yesterday, I don't think we have to worry about that.
So, Joe, putting it all together, what's the Vanguard U.S. GDP call for 2025, and maybe what are some of the levers that might move that one way or the other?
Well, we were going into this year before, some of the election closer to 3%. We have tamped down those expectations because I think we'll see some moderation on some of those good luck measures we saw in 2024. So I think around slightly above 2%, above the trends, the Fed's long-term estimate, that would be a good outcome. But I think again, the wild card will be how far can the Fed continue to cut if growth remains high. And again, the stock market needs those sort of fundamentals because it is fairly priced to perfection, even yesterday notwithstanding.
And to your point, I mean, this is 2 consecutive years now, back-to-back gains of more than 20% in the S&P 500. So how long specifically do you think it could take to get closer to that 2% goal for the Fed?
A little bit more. I mean, financial conditions are supportive, but again, what's much more important is what's happening on the labor supply and productivity. We don't think we're in the midst of a huge AI boom yet. It's just adoption is not too high. So I think that puts us into the 2-ish% range for growth, which is not bad when you consider, a lot of the policy that has been behind us and that could be in front of us. So again, I'm looking at GDP growth and how can that continue to remain strong. There's good momentum in the economy. I think that's good news.
All right, Joe, thanks so much for joining us. Really appreciate it. Joe Davis, he's a chief economist at Vanguard. Appreciate getting a few minutes of his time. Again, the Fed kind of, hawkish cut yesterday, I guess is a way to phrase it. The dot plot suggested maybe a couple of more rate cuts next year, about half of maybe what the market was thinking beforehand. So that's kind of what you saw in the market yesterday.
I know WIRP can be all over the place when you look at that function in the terminal, but actually right before the meeting, it was pricing in 2 cuts, and as well as what the dots showed in the Fed. So it was the first time all year it actually had been in line, but there were other things that had happened that obviously stocks are moving on.
Exactly. All right, with our news in New York City, here's John Tucker.
All right, guys, with a month ago before he returns to the White House, Donald Trump shaking up Washington again, trashing House Speaker Mike Johnson's plan to avoid a government shutdown before the holidays, and demanding a debate on the debt ceiling now rather than after President Biden leaves office. Bloomberg's government Jack Fitzpatrick is following from Washington.
It's a really remarkable thing to see this demand by the president-elect out of the blue, which he clearly had not communicated with any of the relevant players, saying, now I want a debt limit vote in the next couple of days. And I might even want you to eliminate the debt limit. Or his words were terminate the debt limit.
Bloomberg government's Jack Fitzpatrick reports Speaker Johnson now huddling with allies to come up with a plan B to avoid a shutdown when the current funding runs out tomorrow night. Ho, ho, ho. Oh, no. Just in time for the holiday rush, thousands of Amazon workers have walked off the job and onto the picket line. Now, according to the Teamsters Union, this includes about 10,000 Amazon workers at facilities all across the nation in New York, Skokie, Illinois, Atlanta, San Francisco, and Southern California. The big question for consumers right now, with this action coming less than a week before Christmas and Hanukkah, will there be any delays in shipping gifts purchased on Amazon? At this point, organizers have not said how long this is going to last. Luigi Mangione, the suspect in the fatal Midtown Manhattan shooting of a top United Health Group executive, could return to New York to face murder charges as soon as today. Mangione is scheduled to tell a judge in Pennsylvania whether he's going to continue to fight extradition. He was indicted Tuesday on murder and weapons charges over the December 4th death of Brian Thompson. And while Mangione had previously said he would fight the transfer, he is poised to agree to be sent to New York, at least according to our sources. If he drops his opposition, New York authorities could deliver him to a downtown Manhattan courtroom as early as this afternoon. Global news 24 hours a day, whenever you want it, with Bloomberg News Now. I'm John Tucker. This is Bloomberg. Jess and Paul.
If he comes to New York, don't they put him in Rikers?
Rikers Island, yes, which we often say is the notorious Rikers Island.
Oh,
and
man.
having been there, not incarcerated.
I was going to ask about that.
Not where you want to spend the holidays.
Oh, my. This is going to get very real very quick for this dude if he ends up in Rikers. Oh, my God. Sorry, we have more coming up. This is Bloomberg. Good morning.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. We've got futures pointing to a higher open, and this is after big losses for all the major index. A quick breakdown. We have the Dow that closed down for the 10th session in a row. That was the longest losing streak in more than 50 years. The S&P 500 suffered its biggest Fed decision day loss since 2001. And finally, the NASDAQ, it was the hardest hit, sliding more than 3.5%. All that said, that sell-off came after the Fed voted to lower interest rates again by a quarter point, and that showed that's also some caution over how fast they can continue to cut. Right now, we have NASDAQ futures up 0.7%, 170 points. Dow futures up 317, and S&P futures up 50. The 2-year yield 4.31%. That's down 4 basis points. The yield on the 10-year 4.53%, and that's up 1 basis point. To currencies, the Japanese yen down more than 1% after the BOJ governor kind of cast some doubt on hopes for a January rate hike. The pound is up about 0.3%. The BOE said it would keep easing rates gradually in 2025, and we have the Bloomberg Dollar Spot Index is little changed. To earnings we go. We have CarMax beat quarterly earnings estimates. Its shares are up about 6%. Then Darden Restaurants, the owner of Ruth's Chris Steakhouse, the Capitol Grill, their shares up 8%. Its full-year sales forecast beat estimates. And finally, Conagra Brands, the maker of Slim Jim, Duncan Hines, it is down 1%, lowered its full-year profit guidance, pointing to higher than expected inflation and also exchange rates. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That is a Bloomberg Business Flash. Paul and Jess.
All right, Lisa Mateo, thank you so much. We appreciate that. Jess Menton sitting in for Tom Keene. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. In just moments, we're going to bring you an interview. Bloomberg's David Gura is going to sit down with Secretary of State Antony Blinken. I can see he and his entourage have just arrived here at 7:31. See, here in our radio studio, we see everything.
We could see it all.
Nobody gets in or out of this building without us seeing that. It's part of being in the fishbowl here. And he and his entourage just recently arrived, so we'll get that to you in just a moment. In the meantime, let's go down to Washington, D.C., check in with Megan Crane. She kind of is our Bloomberg Mornings politics editor for Bloomberg News. She's down there in D.C., which when I talk to people in D.C., I just kind of assign blame to them.
Right.
They're down in Washington.
If anything goes wrong.
So you're like, hey, Megan, is your government going to shut down Friday evening while I'm eating my pizza here in New Jersey?
Yeah, maybe. it looks like it's definitely a possibility. We were very close to a deal yesterday afternoon, and Elon Musk brought Donald Trump along, and they threw sand in the gears of that process. So it's really unclear what's going to happen tomorrow at midnight.
So talk to us more about this debt ceiling battle, because it seems like President-elect Donald Trump was rejecting that bipartisan plan to avoid that government shutdown. But now, obviously, there's a lot of uncertainty in just 48 hours from now.
Yeah, less, right? Yeah. It's really, like I said, it's really unclear what's going to happen. They really need Democratic votes to get things through at this point, because they have a very, very small majority, and there are conservative Republicans who are just not going to vote for a spending bill that doesn't have drastic cuts in it. So, Mike Johnson has used Democratic votes to get things done for a while, and Elon Musk decided that this one wasn't worth doing. And, he convinced Donald Trump of that. And now Mike Johnson is really in a pickle. He has to decide how to move forward. You'll remember that this same calculus cost Kevin McCarthy his speakership just a year ago. It feels like a long time, but it was just last year. And so it's, there'll be some people who might even, if Mike Johnson decides to really, concede more to the Democrats and get them to come along to fund the government, that could change the leadership in the House as of January 3rd.
All right, so we've heard from a couple of civilians, Donald Trump and Elon Musk. How about the president of the United States? Has he and or his administration weighed in on this at all?
Well, so yesterday the White House did, put their muscle, whatever that would be, whatever that is at this point, behind the deal. The Democrats in the Senate and the House negotiated this deal with Mike Johnson, and they expected it to pass yesterday, and they are not going to help the Republicans out of this hole at this point. They have no incentive now to come back and pass a bill without the concessions that they had already negotiated. So the White House is certainly backing the Democrats on the Hill for that same measure.
So what's next? If Congress can't pass a continuing resolution in that time, the government is going to end up shutting down at midnight on Friday? That's right. Yeah, that's what happens. That is what's next. And, no one wants that at Christmas time. Although some, like I said, some very conservative lawmakers have said, sure, shut it down, right? They're willing to sort of set it all on fire to bring about cuts. I will remind you that the last time the Trump-led government shut down the government, it was 35 days. And in the end, they didn't get what they wanted. They had to sort of concede, right? They had to just reopen the government without the cuts that they were demanding. So, they're really in a difficult position. Now they started talking about debt ceiling increases yesterday, which had not been sort of in the calculus.
Yep.
I'm sorry, go ahead.
All right, Megan, we're going to have to go. We have some breaking news here. Meghan Crane, thank you so much. We appreciate it. Meghan Crane from Bloomberg News down in Washington. Right now, let's go to David Gura. He's interviewing Secretary of State Antony Blinken on Bloomberg Television. Let's go to that right now.
That's right. You have what seems like a de facto government that is a designated terrorist group, and you've said that the U.S. has been in contact with HTS. Mm-hmm. What specifically have they said? I know there are other groups operating in the country as well. But what have they said about how they might govern if this is how it all shakes out?
What we've heard them say is positive. The question is, what are they actually going to do? We brought together with Jordan countries from around the region last week. We had Turkey, we had Iraq, we had the Gulf states, Jordan, Egypt, European partners. And we came together to set expectations. What is the international community? What are the neighbors looking for as this transition takes place in Syria? And we all agreed. We want to see something that's inclusive, that's non-sectarian, that respects minorities, women, that deals with any chemical weapons that may be remaining in Syria, that doesn't ally with ISIS or any of the terrorist groups that are there. And the reason that's so important is we want to make it clear to HTS and all of the emerging authorities that the recognition that they seek, the support that they seek and need from the international community, well, there's certain expectations that come along with that. And as I said, we've heard positive statements coming from Mr. Gilani, the leader of HTS. But what everyone is focused on is what's actually happening on the ground. What are they doing? Are they working to build a transition in Syria that brings everyone in? If they do that, and if they meet some of these other tests that the international community is looking for them to meet, then I think you can see something very positive. And here's what it is. for the first time in decades, the people of Syria can go forward without a dictator, without a terrorist group dominating their lives, without one sect or one group running things at the exclusion of others, and without foreign power calling all the shots. That's the opportunity, but it really requires HTS and other groups that are there to move forward in this inclusive way.
You've said that the U.S. wants to help, and I look at this country that has a lot of sanctions that are residual. A lot of sanctions have been in place for decades on Syria. Senator Chris Murphy of Connecticut has called for a temporary suspension of sanctions. Is that something that you would be amenable to, and would that be effective in helping you have more engagement with what may be this new government?
So we're looking at all the authorities we have. We're looking at all of the sanctions, not only our own. The United Nations has sanctions on HTS, its leader, and I think what we need to see is actual concrete steps, building an inclusive, non-sectarian government, a transition, eventually getting to an election. As we see these steps taken, then I think we'll be able to respond. Others will be able to respond. That's what we'd like to do. But we need to see concrete action, not simply positive declarations.
The EU's chief diplomat has said she's sending a senior representative to Damascus to talk to this new group, talk to this government. Is that something that you would want to do, that you can do, indeed, given the terrorist designation and the sanctions that are in place?
We've actually been in direct contact with HTS.
On the ground?
I can just tell you we've been in direct contact, and we're also looking at getting people on the ground in Syria. I think it's important to have direct communication. It's important to speak as clearly as possible, to listen, to make sure that we understand as best we can where they're going and where they want to go. So we'll be looking at pursuing that in the coming days.
Pull back and ask you another question about the region, and there's been a lot of speculation that a ceasefire deal could come together. When President Biden spoke about the deal between Israel and Hezbollah, he was asked at the end, do you think you can get a ceasefire deal by the end of your tenure? He said he's hoping and praying. Is there anything that's happened that gives more grounds for hope and prayer going forward here?
There is, and the reality is we should logically be able to get this. And I say that with all the caution that comes with that statement, because, you know, we've been very close before, and we've had these Lucy in the football moments where you're just ready to kick the football and Lucy pulls it away. But what's changed is this. Hamas knows that the cavalry is not coming to the rescue. For months and months and months, it hoped it would get a wider war with Hezbollah, with Iran, with Iranian-aligned groups coming in and creating more problems from Israel on more fronts and helping Hamas endure. We now know that's not happening. They know it's not happening because of the very important work that was done with us and with others, dealing with the unprecedented Iranian attacks on Israel, dealing with Hezbollah. So I think that's concentrated minds among Hamas on the need to complete this deal. Having said that, you know, it's always incredibly fraught, and it's very hard to get decisions made. It's hard to communicate. And for all of those reasons, even as close as it is, you know, it can still move in the other direction. But we've all been fanning out, working with all of the different partners who can make a difference and who may have some leverage with, communications with Hamas, whether it's Qatar, whether it's Egypt, whether it's Turkey, where I was just last week. The fundamental question right now is Hamas finally prepared to say yes? And if it does, we get the hostages back. We get a ceasefire. We get an immediate, dramatic improvement in the lives of Palestinian children, women, and men who've been caught in this horrible crossfire since October 7th of Hamas's making. If they really purport to care about the Palestinian people, they will say yes and do it now.
Let me ask you about that horrible crossfire, and it's something that you've written about in a recent essay for Foreign Affairs, the fact that millions have been displaced, tens of thousands have been killed, Gaza has been kind of reduced to rubble. You've made 12 trips to the region. How much regret do you have that kind of sustained level of humanitarian aid hasn't made it into Gaza over the course of this conflict?
You know, from day one, we've tried to do several things, going back to October 7th. First, to stand resolute with Israel to try to make sure that October 7th would never happen again. Second, to prevent this war from going wider, because if that happened, if other fronts opened up, whether it was with Iran, whether it was with Hezbollah, these other groups, more death, more destruction, and it would probably prolong what was going on in Gaza. And three, to do whatever we could to make sure that people in Gaza were getting the assistance they need, were getting the protections they need. And we have been on this virtually every single day, and we've seen moments when more assistance was getting through, Then we've seen moments where it's ebbed and flowed. But this has a dramatic effect on the lives and livelihoods of people in Gaza. The last week or 10 days, there has been a noticeable improvement, but we've seen that before, and then we've seen it fall off. The best way to finally deal with the needs of the people would be to end the conflict, would be to get the ceasefire, to get the hostages home. That's the best way, because you have an environment that is unique. You have a population that's trapped in Gaza. It doesn't have anywhere to go. In most other conflicts, people, they can become refugees. That's not a good thing, but it's better than being caught in the middle of a hot war. And also you have an enemy, in the case of Hamas, that's fully enmeshed with the civilian population, living in and under buildings, apartment buildings, schools, mosques, hospitals. That doesn't obviate at all the responsibility that Israel has to try to ensure that assistance gets to people who need it, and that people are protected as best possible. And we've been pushing on that every single day. We've also seen what's possible if there's real sustained focus on this. There was a polio vaccination campaign to make sure that little children in Gaza got these vaccines, and it was very successful. Until there's an end to the conflict, what we've been trying to impress upon the Israelis is the need to bring that same focus in a sustained way on getting assistance to people who need it.
Ask you a last question just about the transition that's underway, and you've said of this new administration, you want to pass the baton to them so they can get off and running. Forgive me, but it does seem like they are off and running. You had President-elect Trump meeting in France with President Zelensky, President Macron, he's met with Prime Minister Trudeau in Florida, his designate to be the special envoy to the Middle East has been in the region as well. Does that complicate the work that you are doing, having that sort of separate voice, separate foreign policy, for lack of a better word, in the region while you're trying to do your work?
Look, there's one president at a time, one administration at a time, but we're in very close contact with the incoming administration. I spent a couple of hours.
It does feel novel, though. I mean, we used to talk about the Logan Act. It does feel like these are different circumstances.
Look, I think there are a few things. I think there are a few things going on. First, as I said, we've been in very close contact with the incoming administration. I've spent a lot of time with Senator Rubio and Jake Sullivan, the National Security Advisor, with Mike Waltz, his successor. We've had very good, not only conversations, but we're trying to make sure that we're as coordinated as possible so that they know what we're looking at doing in the remaining time that we have. I want to be able to hand off to the incoming administration the best possible hand to play in all of these areas, in all of these challenges, because the world doesn't stop just because we're in a political transition. It's also normal that countries around the world want to hear from the incoming administration. They want to know what they can expect, and so they can get ready for that. As long as we're communicating closely, which we are, and as long as we're working to, again, try to make this handoff as effective as possible so that they can get moving on the run, because there's really no time to wait, then I think that's a good thing. And look, on the Middle East, just to stick with that quickly, we've been working very hard to make sure that, as best we can, we actually start to implement plans for a better future for the region, or if we don't have time to fully do that, to be able to hand them off. Not just getting the hostage and ceasefire deal, but having a clear plan for what follows, a day-after plan for Gaza, so that there's no vacuum that Hamas can refill, that Israel can pull out, and you can have Gaza stand up for its people. Administration, security, reconstruction. We have done an extraordinary amount of work carrying through what President Trump started with the Abraham Accords to get normalization between Israel and Saudi Arabia, which would be the biggest game changer in the region. And those plans are there and are in place and ready to go if we get an end to Gaza, a conflict there. We've done a lot of work on what a pathway to a Palestinian state would look like when people are ready for that conversation. They're not now. At some point, they're going to have to be. All of that is ready to be handed over to the new administration, and hopefully they'll carry the ball forward.
Very quickly before I let you go, you mentioned that normalization deal. It was something this administration invested a lot in before October 7th. Clearly, the conversations have been going on. There has been reporting that we're close to a breakthrough there. Is there? Can you shed any light on sort of where those conversations stand today?
So one of the things I look back on is on October 10th, a year ago. I was supposed to go to Saudi Arabia and to Israel to work on the Palestinian component of this normalization deal. And of course, that trip didn't happen because of October 7th. But even with Gaza, we've continued these conversations, we've continued this work. And in terms of the agreements that are needed between the United States and Saudi Arabia, they're pretty much ready to go. And that would then trigger the normalization between Israel and Saudi Arabia. But two things are required to actually get that done. One is an end to the conflict in Gaza, and two is having a credible pathway toward a Palestinian state. As I said, all of the work's been done, and hopefully we'll get to that end of conflict in Gaza. They'll have to engage the conversation on the answering the Palestinian question, but the work is there. And if that happens, this transforms the region. You have Israel that's integrated in the region. There's a common security architecture to deal with Iran. We saw that, something we put together embryonically when Iran attacked Israel in an unprecedented way, a direct attack. We not only, for the first time, participated in Israel's active defense, we brought other countries, including countries in the region, into that defense. So you can see what's possible in the future. But it requires an end to the conflict in Gaza, and it requires moving forward on the Palestinians.
Mr. Secretary, thank you very much. That's Antony Blinken, Secretary of State. I'll send it back to you.
All right, that was Bloomberg's David Gura sitting down with Secretary of State Antony Blinken, going over a wide range of geopolitical issues, focusing on the Middle East. And Secretary of State Blinken voicing some optimism that some type of peaceful solution to what's happening in the Middle East, particularly with the hostages, might be achieved prior to the end of the Biden administration. That's what they're working towards.
Right, and showing some pragmatism there, Paul.
Exactly. Wendy Schiller joins us right now, professor of Brown University. And just get some thoughts here on what's happening geopolitical. Wendy, I know you listened to that interview as we did. Secretary Blinken, again, voicing some optimism that maybe some progress can be made there in the Middle East over the coming weeks.
Well, good morning. I'm sure that the Biden administration, particularly Secretary Blinken, would like to see the release of the hostages and some sort of more permanent ceasefire reached in Gaza before January 20th. Biden's had a pretty rough ending to his presidency, and I think the world would like to see this conflict come to a close and have the hostages released. It's a little reminiscent, although many of us might have been quite young at the time, but for the hostage release in Iran and Ronald Reagan's presidency in 1981. But you have to think this is a complex world, and what Blinken's trying to say is we are leaving it in the best shape we can, and we are communicating with incoming Secretary of State Marco Rubio's team, and that there is stability in U.S. foreign policy. And I think that's something very important that at least the Biden administration wants to project for the incoming Trump administration.
And speaking of the Trump administration, Wendy, I wanted to point out a flash that we have on the terminal here. It was Trump talking actually to Fox News here, saying that Johnson to remain speaker if he acts tough enough here. What's your reaction to this as far as when you have the president-elect? Obviously, we still have less than a month before the inauguration. We actually have just a little bit because it'll be on January 20th. But your expectations here where he's talking tough ahead of this?
Well, I mean, I think this is a really, I don't think it's a well-advised strategy on part of the Trump administration, incoming Trump administration. This is Elon Musk. This is people who really want to not just roll back the federal government, but completely undermine its foundations. We have seen in this movie before, not only in the Trump administration, way back to Gingrich and Clinton. Gingrich shut the government down going into Christmas also, by the way, and Clinton ended up winning the election in '96 quite easily and made Gingrich the scapegoat. So it's really it's not a winning strategy in the longer term. It doesn't set the right tone for Trump, who said he would come in and fix things. And then he's sort of encouraging the Congress to break it. Because he thinks he wants the debt ceiling. I think this is all about getting the debt ceiling because he doesn't want to deal with this brinkmanship 6 months from now when he's president of the United States. So I think that if he got assurance they would do the debt ceiling now, which the Democrats probably have no interest in making easy for incoming President Trump, he would relent. So this could be just one big gambling bit just to get the debt ceiling off the table so it doesn't interfere with his first year of the presidency.
Can you explain, Wendy, for our listeners, our viewers, and me, what the debt ceiling issue is?
Well, basically, I mean, this is just the amount of money, as many of your listeners already know, that the government can, quote unquote, borrow. That's a complicated set of activities, that borrowing, but one of them is to issue treasury bonds, right? So, and interest rates are falling, so it's a little bit cheaper, although treasury rates obviously vary in some ways that are separate from this, a little bit cheaper to do that if interest rates are coming down. So it's easier to, borrow money, and that's what the government would be doing. The problem is when the government runs out of money, it literally cannot operate. So it's similar to a shutdown, but the legal implications are quite different. So it's really something you don't want to deal with. And the renegade Republicans have made this a difficult task. Even under Trump, they sort of grumbled a lot for a long time, and the debt is growing. And Trump is somehow going to have to face that. So, it's just that he doesn't want to deal with it in the first year because it empowers some of his members with a very slim majority in the House. If Mike Johnson has to shut the government down, then that sits on Trump, not Biden. And that's why I feel like this is a very curious strategy going into inauguration and the start of the second term of Trump.
So what do you think are the scenarios that could avoid a shutdown this week, and based on what we've seen in the past?
Well, in some ways, I mean, there is a lot of spending in this bill that, as there always is, that you could argue is not vital or necessary. And I think if there's some concession on some of that spending, that gives Trump the opportunity to say he was influential and save face. But ideally, he'd like the debt ceiling extended, so he doesn't want to deal with it. So I don't know if they're willing to do that in 24 hours. But going into the holiday, as it goes along, unless they exempt things, which sometimes they do, like fundamental services, the FAA, for example, for all these people going on vacation, national parks where people might be planning trips to. We've seen this movie, as I said before, and it doesn't end well for the party that's blamed for the shutdown. So I think that's the negotiation, and Trump has put himself out there, and maybe now he feels like, oh, now I have to backtrack, or maybe he thinks people go on Christmas break and they won't even notice, and he'll get it done for the new year. But this is not the way you want to start your new administration.
Wendy, are you surprised that we have two civilians here, Donald Trump and Elon Musk, having such an influence over these types of matters? And quite frankly, I have not really heard, or I don't think we've really heard from our president, Biden, about how he views this negotiation. How odd is this scenario here?
Well, I mean, it's actually, Trump did this before with the immigration bill. The Congress was ready to pass a border security with some immigration reform, and he killed it. He killed it by saying, I don't want it, and I'm gonna primary you. I'm gonna get people to run against you in primaries. And the Republicans folded at the last minute. This is just wholesale, the capture of the Congressional Republican Party by Donald Trump. The key is it's captured in the House, but it may not be as wholly captured in the Senate. So if Republican senators don't want to shut the government down, they'll go to Donald Trump and say, well, we're reconsidering your nominees. I mean, I don't know who in the party will do that for an incoming president who's so popular. But that popularity could be fleeting if people find they're inconvenienced by Donald Trump and Elon Musk. So this, again, is a gamble by the incoming president. And like we've seen before with Donald Trump, it's not always a rational explanation for it. But if they come to the table with the debt ceiling extension, you can see Donald Trump flipping the script and saying, okay, don't shut the government down. And Congress can stay in session on Monday and Tuesday next week. It's not a popular thing to do for the members, but they could certainly be in session Monday and Tuesday to work this out right before Christmas.
Talk to us about Elon Musk and how he's starting to staff up his Department of Government Efficiency, because there's still a question of how exactly it would operate, because leading a commission outside of government, Elon Musk doesn't have to divest his personal financial holdings when making recommendations to the White House.
Well, this is not a cabinet department, right? We have cabinet departments. They're created by acts of Congress. So I don't know what the legal authority would be, as you suggest, Jess. Like, what actual legal authority would they have? So it'll be a commission. Remember, when Trump came in the first time, he formed a voting commission. He put Chris Kobach in charge of that and demanded information from states about voting records. And states said, yeah, no, we're not going to do that. So it's unclear how effective these recommendations will be without any legal implementation authority. And how long will Donald Trump share the spotlight with Elon Musk? We all have to ask ourselves that. It's Musk, Musk, Musk. Trump likes it to be Trump, Trump, Trump. So it's unclear how long this friendship lasts and how far-reaching Elon Musk can be. It is hard to move the needle in the federal government. It's hard to change things and cut people. And it will take a while for anything to come to fruition. And we just have to figure out whether the relationship between Trump and Musk withstands that timeline.
Wendy, thank you so much for joining us. We always appreciate getting your perspective. Wendy Schiller, professor at Brown University. A lot of geopolitics in the last 15 minutes. David Gura sitting down with Secretary of State Antony Blinken, getting the latest update from the Middle East. Again, the administration hopes to get some type of resolution to at least a hostage situation there in the Middle East. That's what they're working towards in the remaining weeks of their administration in that part of the world. And then, of course, here domestically back in the U.S., thinking about whether this government's going to stay open beyond midnight Friday. It seems like we have these conversations every year, it seems like.
I know, it keeps popping up, and then Blinken obviously saying in that interview on Bloomberg Television with David Gura that he wants the best possible handoff to the Trump team, Paul.
Yep, seems reasonable, rational to me. S&P up 45 points. Dow up 325 points. That's 0.8%. The NASDAQ up about 0.7%.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Well, we got futures on the mend after the Fed signaled a plan to slow interest rate cuts and sent stocks really plummeting yesterday. Today, we have more economic data out post-Fed. Third quarter revised GDP. Now, the expectation was for an increase at a 2.8 annualized rate. It came in higher, 3.1%. We also had initial jobless claims. The survey was for 230,000, came in lower, 220,000 applications. They were filed last week. Next up, 10 a.m. Wall Street time, we have existing home sales. Let's get to futures. NASDAQ futures up 0.6%, 139 points. Dow futures up 0.7%, 309 points. And S&P futures up 0.7%, 42 points. The 2-year yield, 4.30%, down 5 basis points. The yield on the 10-year, 4.54%, and that's up 2 basis points. The Bloomberg Dollar Spot Index is down about 0.1%. Few companies making news. Stellantis kind of shifting gears, saying it's going to delay its first all-electric truck to 2026. The reason why? Well, they want to prioritize that extended range pickup, the Ram 1500 Ram Charger. And the FAA's review of Southwest Airlines, it has come to an end. The agency said it found, quote, no significant safety issues. That is your Bloomberg Business Flash. Paul and Jess.
All right, Lisa Mateo, thank you so much. We appreciate that. Jess Menton sitting in for Tom Keene. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, and we are streaming live on YouTube. That is the internet, Jess. YouTube.com, search Bloomberg Podcast, and that's where you'll find the video aspect of this whole thing here. All right, so yesterday afternoon, after 12, when I leave the air, the world stops. I'm done.
Of course.
But apparently there's a Fed meeting yesterday, and there was a market reaction yesterday. I'm putting all the blame on Carol Masser and Tim Stenovic for that market sell-off.
Doing the afternoon show.
But we got an expert coming in here today. We really appreciate that. Second day in a row in our studio. Thank you so much. Danielle DiMartino Booth. She's the CEO and Chief Strategist at QI Research. Danielle, what did you take from yesterday's meeting, press conference, all that kind of stuff?
I don't think the market likes surprises.
Right.
And I think you should stay past noon today, possibly, just for the greater good.
Okay.
Please. I don't know if yesterday was about legacy. You know, we've got 16, 17 months left in Jay Powell's term. I think he is going to be 100% about optionality. If he was an economist yesterday, he was an economist with 3 arms. On the one hand, on the other hand, and on the other hand. When you look at the largest input to inflation, it's running at about 2.6% on an annualized basis, the lowest since 2021. So that large, huge driver of inflation these last few years is coming down. Ivy Zellman just came out with her apartment operators survey this morning. She's showing the same kinds of downside because occupancy right now is at the lowest in records that she's got back to 2001. So there's a supply overhang that's going to continue to be kind of an anchor on rental inflation. That's ironically something that Beth Haddock might have communicated from the Cleveland Fed, since they're running the Fed's only real-time rent index, and yet there she was, the dissenter.
She was.
And obviously, there's two crucial debates when it comes to the direction of Federal Reserve policy. We've talked so much about this. What's the neutral rate for the post-pandemic economy? And then also when you're thinking about policy changes, whether it's tax, immigration, regulation, trade, tariffs, and obviously the inflation forecast. So how do you view those two issues going into 2025?
Well, and there's a huge unknown. Let's just say that the tariffs have double the effect that they had in 2018, 2019. You're starting off with goods at negative 0.6. Goods. You're starting off at a point of goods deflation. Even if you get double the effect of 2018, 2019, because of the anchor that I just mentioned to you, which is rent, disinflationary pressures, the Fed's still going to come in below where their end of the year inflation forecast is. So again, I think right now that they're playing out scenarios, and they're playing out what ifs, and they're saying if the peanut butter hits the fan, we want to be ready to be in less of an aggressive easing stance. I don't see much beyond that. January tends to be a throw the baby out with the bathwater type of month. You tend to see layoff announcements spike. You tend to see bankruptcies lift off of where their current run rate is, which, according to BCY Go, you're at about 20 for the month of December on a run rate basis. You hit 22 in the month of November. That was the second highest in post-pandemic era. So if we continue to just see more of the same, and again, January tends to be a very ugly seasonal month because anything that you've been holding off of, if the holidays didn't lift you up and pull you through, then whether you're the Container Store or Big Lots, you're going to liquidation pretty soon here. So I appreciate the optionality. I was surprised at the magnitude of the surprise to the markets, but maybe he's saying I'm not going to be the next Arthur Burns, come what may.
Yep. Well, you always remind us of this BCY Go function on the terminal, and I always forget it, but it's a great function to show you bankruptcies and the companies and the industries they're in, the assets, the liabilities. A great function. So the dots. And DOTS, another cool function on the Bloomberg terminals. I guess we're kind of going from 4-ish to 2 in terms of rate cuts for next year.
Yeah.
Is that reasonable from your perspective?
According to the terminal end of the dot plot, which you could have driven a Mack truck through, no. I mean, the disparity, 2.4% to 3.9%, 150 basis points of disagreement. Let me tell you, I was inside for 9 years. That's a lot
at the Dallas Fed.
At the Dallas Fed. But I was there for the pre-briefs, I was there for the debriefs, 150 basis points of disparity with 17 members of the Federal Open Market Committee is a lot. And that's how far apart views are on what the terminal rate's going to be.
And we saw another dissent, obviously, at this meeting. How do you view the debate amongst officials at the Fed as they get closer to where they think the neutral rate is?
I think they're wondering about this new kid on the block. Beth Hammock can come back. Usually you get your sea legs as a district president.
She came out swinging.
But she came out swinging and swinging hard. And what was curious to me, though, was if there was one person among the 17 who was saying, no, I'm voting for a pause, why wasn't she joined by Michelle Bowman, who was equally hawkish a few meetings ago? From her, we saw the first Federal Reserve governor dissent since Mark Olson had done that in 2005. So I was surprised if there was that robust of a debate that there weren't two hawks and a double dissent yesterday.
Right, because you usually think Chris Waller, too, is kind of on the hawkish spectrum as well, in addition to Mickey Bowman.
Well, but Chris Waller is also Jay Powell's first lieutenant, closest confidant, never going to vote against the boss man. I said it out loud, yeah.
Beth Hammock, I was just looking up her bio on the Bloomberg terminal. I forgot she's the Goldman Sachs person, so no surprise, I guess, that she would feel comfortable being outside the loop a little bit.
And there's nothing wrong with that.
No.
I mean,
it's just
we have to
that,
have dissent on the board.
Yep.
And I think the investing public needs to know that it's not just one great big oval table in the Eccles building surrounded by yes men and yes women.
Yep. So, I mean, where do we go in next year? What are you telling your clients about 2025? Is there a theme you're talking about with your clients?
I'm telling my clients that either Trump lands in office and the private sector wakes up and says, we're finished firing people, we're finished cutting costs, despite the fact that in earnings season, we've been hearing one company after another not miss on their bottom line, but miss on their top line. So ConAgra, again, we're not seeing the consumer consume. Yesterday, that General Mills, ConAgra was echoing General Mills yesterday, saying, thank heavens we sell food that people eat at home because they ain't eating out, which is something we saw in the retail sales, right, with a negative print for restaurants. So we're going to have to see a turnaround in the consumer. I'm not so sure that that's going to be the case because the credit reporting bureaus in January, they get to hear about 50% or so of the 42 million Americans who still have student loans who haven't made a payment since March of 2020. That to me signals that there's going to be a little bit more underwriting strictness going into the new year because you're going to see the consumer finally take their lumps after not having paid for nearly 4 years on these student loans. Nothing's been reported since then. January, if you were not paying as of October the 1st, 2024, you finally get reported to the Experian and TransUnions of the world.
All right, Danielle, thank you so much for joining us again. Danielle DiMartino Booth, she's based down in Dallas, but we appreciate when she comes to New York, she gives us some of her time here in our studio. We really appreciate that, particularly around Fed Day. And again, we had a pretty active Fed Day yesterday, so we appreciate that. Danielle DiMartino Booth, CEO and Chief Strategist at QI Research. What else are you looking at?
Well, actually, she was bringing up ConAgra and consumer packaged good companies, and that was something I talked to Thomas Barkin from the Richmond Fed about 6 months ago, what they were watching with when it comes to balance of price and volume growth for these consumer packaged good companies. So he was saying he's actually looking for more of a read-through for there, too. So you can look at that from the earnings perspective as well.
ConAgra, based in Chicago, Illinois, 18,000 employees. We'll have more coming up. This is Bloomberg. Good morning.
This is Bloomberg Surveillance with Tom Keene and Paul Sweeney.
What do you say to people scared stiff in cash?
We've got an administration, presumably, that will be pro-business, lower taxes.
With Lisa Mateo on markets.
AI affecting demand for cloud computing.
And Michael Barr with news.
U.S. Secretary of State discussed the conflict in Gaza.
The best in economics, finance, investment, and international relations. This is Bloomberg Surveillance on Bloomberg Radio.
All right, coming up in this hour, we start strong. Frances Donald, chief economist at RBC. She speaks French. Phil Tays, founder of Tays Asset Management. I think this has been 5 years, and I think I've got I think I'm still mispronouncing the name of the firm wrong. We'll figure it out.
As well.
He's going to be in studio. We'll figure it all out there. Angie Gilday, U.S. energy leader at KPMG. Talk to us about the energy business out there, supply and demand of energy. We got WTI crude oil right around $71 a barrel. The real question about demand out there. So we'll break down the global energy space. But right now, let's kick it all off with Lisa Mateo on a Bloomberg Business Flash.
And we've got futures pointing to a higher open. Stocks took a real nosedive following the Fed making another interest rate cut and signaling just 2 more rate cuts for all of 2025. We also had some more economic data out this morning. The U.S. economy expanded at a faster pace in the third quarter than expected. A big part of that, stronger consumer spending. So you have gross GDP increase at a 3.1% annualized rate in the third quarter. NASDAQ futures up 0.4%, 103 points. At Dow futures up 0.6%, 279 points. And S&P futures up 35. The 2-year yield at 4.31%, down 4 basis points. The yield on the 10-year 4.55%, and that's up 3 basis points. Monetary policy, not just news here in the U.S. You have the Bank of England kept its rates unchanged. The pound is up about 0.1%, and we have the stock 600 down about 1%. In Asia, the Bank of Japan kept its settings unchanged, but comments by the BOJ governor kind of squashed those hopes on whether it could hike rates in January. We have the yen that is down more than 1% at 156.94 against a dollar. The Bloomberg Dollar Spot Index is little changed. Shares of Micron Technology down 11%, delivered that revenue forecast that missed projections by about $1 billion. And home builder Lennar down 7%. Its forecast for new orders in the first quarter missed estimates. After the close, we're on to FedEx and Nike should be interesting. CEO Elliott Hill facing his first earnings call since accepting the job in September. That is your Bloomberg Business Flash. Paul and Jess.
All right, Lisa Mateo, thank you so much. We appreciate that. Jess Menton sitting in for Tom Keene here this morning. It's like we never missed him. Jess Menton slides right in. You know, it's like Tom Keene. He'll be back sometime next week, I think, is the call there. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker studio. We're streaming live on YouTube as well. So head over to youtube.com, search Bloomberg Podcast. That's where you'll find us. Big day if you're economist yesterday. I mean, you had the U.S. Federal Reserve cutting rates, talking about this economy, talking about inflation. Big move in the markets yesterday. We're getting a little bit of a recovery here in the futures market here. Frances Donald joins us. She's the chief economist at RBC. That's Royal Bank of Canada. Frances, what did you make of the Fed's statement yesterday, maybe the chairman's comments, and then the market's reaction? What did you take away from that?
Well, interesting. Almost no change to the statement, and actually not a material change to the forecasts for growth and for the unemployment rate. But of course, the big focus now moving towards inflation. And it just struck me as very interesting that, yes, we've had some minor surprises to the upside with inflation in the past few months, but that was a really big move and a big change in policy outlook off of the data that we've seen. I could have maybe seen a slight change in tone or maybe taking out one of those cuts for next year. But this is really a Federal Reserve that, even though they say they're not incorporating the effect of Trump policies, or some of them are, but some of them are not, is absolutely internalizing what they expect to come next. It is in their psyche, it is in their biases. They are afraid of inflation. And Powell, while trying to speak out of both sides of his mouth, really gave the impression that the Fed is focused on what those CPI, PCE numbers are going to look like, and therefore that's what the market will be focused on.
And you're hinting at how Powell was talking about during the press conference, how there were some officials, not all of them would identify that, but that there was policy uncertainty, especially when they're thinking about the trajectory of when it came to inflation, starting to incorporate that in their dots and their outlooks for 2025 and the years ahead. And obviously, Powell isn't going to address kind of the elephant in the room when you're thinking about the plans for fiscal side of that, but they're going to focus on what's going on with the economy and inflation. So how do you think the Fed moves forward? Because when you think back to even the last admitted time Trump was in office, it's not really the same type of playbook, because the Fed's trajectory with rates was in a very different spot as the economy was, and that was well ahead of what happened with COVID.
Well, back in 2018, a scary inflation would be like 3%.
Right.
That would have been, for many folks, that would have been some of the highest inflation that they had seen. That would be enough to spook bond markets. Now, of course, we're old hat at 3%. It's not so terrifying. But the American people have gone through, for many of them, the largest price level shock that they've experienced in their entire lives. And prices are over 30% higher than they were when Trump first took office. So that the ability to withstand and take higher prices is going to be much lower for households, for businesses, and also for the Federal Reserve. You mentioned fiscal. I think this is really key. You know, I think we're still, consensus economists and markets, underappreciating how massive fiscal spending has been in the United States and how much it has complicated the Federal Reserve's job. So they talked a lot about what neutral is yesterday, but then they talked about maybe short-term neutral and long-term neutral. And to me, that was a nod to just how big fiscal spending has supported growth. And we've seen it today in some upward revisions. If we get a pullback in fiscal spending or an acceleration in fiscal spending, that is a huge input into the Federal Reserve, probably more important than just tariffs alone, which they've said they can look through to a certain extent.
So can you just define for me how you define neutral rate? And how's that changing over time?
So generally, the textbook definition is the rate that is neither tightening nor easing on the economy. We don't know what it is, and actually we have even less visibility into it right now because of a few factors. One, of course, is how big government spending is and counter-cyclical government spending. The other is that we know there's a tremendous unevenness that exists underlying this economy. So even though on the surface the economy looks good, it's actually doing real bad for manufacturers. Housing is really struggling in low-income Americans. So their neutral rate is going to be different than the neutral rate for the whole economy. And then underlying the surface, we have this AI and productivity boom, which is probably meaning that the economy can grow sustainably higher from where it was. So there's short-term factors and long-term factors. How has my thinking changed on that? Well, the uncertainty around neutral is much larger. And what that effectively means is that if you can't see in front of you, you don't know where the cliff is, the odds that you fall off of it are much larger than if all the lights are on or it's sunny outside. So my concern with neutral is that this is a Fed that's very wedded to the idea of getting to neutral and then staying at neutral. But given that we have very little understanding of what it is, the odds of a policy mistake on either side of it is much higher now than it would have been even 2 years ago.
And you were bringing up sort of the dynamic because when we're looking at, say, data that's coming out, I mean, we just got an update on third quarter GDP coming in revised higher at 3.1%. Obviously, we'll have another update on the Fed's preferred gauge for inflation tomorrow with PCE. But we think a lot about the rate of change when you're looking at the month-over-month or year-over-year figures. But when you're going to the grocery store, a lot of people obviously are thinking about price levels, what they were spending and paying for things before COVID, obviously, versus now. Those kind of psychological impacts. How long do you think it'll take before, how many years could it take before that kind of shakes out? Because there's a very disconnect there for people.
I think this is generational inflation trauma. I think when we hear, when I work with folks who talk to me about the 1970s and how that framed their entire perspective on markets, I mean, prices are up 20% in just 4 years. It is phenomenal inflation that we never expected to see and many didn't believe could occur. But more problematically, it's coming from sources that are not interest rate sensitive to the same extent. And that complicates the Fed's job because they can hike interest rates all they want. It's not going to solve geopolitical fragility. It's not going to make it rain in Brazil when there's droughts that occur. So it isn't just inflation. It isn't just the price level shock. It's the nature of how inflation is changing that I think is particularly problematic. But Chair Powell did mention this, and I think this is really important, that there's a difference between high prices and high inflation. The side point to that too is inflation is problematic when it doesn't come with wage growth. So if prices are more, if things cost more but you're making a lot more money, it's not going to bother you as much. So inflation really started to be something we're talking about a lot more, really much more in the last 12 to 24 months when wage growth started to decline versus in the first stage when we had checks going out and wage growth was accelerating and the labor market was tight. So when I think about inflation, when I think about the neutral rates, I'm also bringing into the perspective of what is wage growth doing in this environment.
Well, I want to ask you too, because the incoming administration has made promises to lower prices, but when you're thinking about the fiscal side of things versus the monetary side, I mean, what real options does an administration have in order to do that, and is that even possible?
Well, lower prices would mean deflation. That means CPI that's negative, and we're struggling to get there right now. That might be something that can be achieved in pockets, but just getting down to 2% is really the challenge. Fiscal is going to be such an important component to this story. I've been on this show, I think it was here last month, and talking about how important immigration will be, how immigration actually weighs on our outlook and our concerns about the U.S. economy more than tariffs, which tend to be one-off shocks, and we know how to use them. But this is a government, the U.S. government, if they pull back on spending, they'll be able to create disinflation and help bring it back and allow the Fed to ease more, but it's also going to pull back on growth. So in my mind, it's going to be difficult for the fiscal arm to create disinflation or deflation without also materially reining in GDP. So pick your poison.
Yep, exactly. Frances, thank you so much for joining us. Frances Donald, she's a chief economist at RBC based in Montreal, Canada, joining us here in our Bloomberg Interactive Broker Studio. With our news in New York City, here's Michael Barr.
Paul and Jess, Secretary of State Blinken says the U.S. has received positive signs from the rebel group that swept Bashar al-Assad from power in Syria and is considering sending American officials into the country to press for a smooth political transition.
We want to see something that's inclusive, that's non-sectarian, that respects minorities, women, that deals with any chemical weapons that may be remaining in Syria, that doesn't ally with ISIS or any of the terrorist groups that are there.
Blinken, speaking to Bloomberg this morning, also suggested chances have improved for a ceasefire between Israel and Hamas. The risk of a government shutdown just got a lot more real in Washington. President-elect Trump coming out against the stopgap spending bill that lawmakers agreed to just this week. Vice President-elect J.D. Vance was on Capitol Hill last night, kicking off new negotiations with fellow Republicans.
We had a productive conversation. I'm not going to say anything else more about it tonight because we're in the middle of these negotiations, but I think we'll be able to solve some problems here, and we'll keep working on it.
J.D. Vance and President-elect Trump say they want a clean bill. It doesn't include any add-ons. House Minority Leader Hakeem Jeffrey says a deal is a deal.
House Republicans will now own any harm that is visited upon the American people that results from a government shutdown or worse.
Well, Jeffrey's comments echoed by the White House, saying Republicans should keep their word. Amazon warehouse employees and contract drivers in 4 states walked off the job this morning ahead of the holiday delivery rush. Randy Corrigan is with the International Brotherhood of Teamsters.
They claim that those contractors, the so-called contractors that deliver for them, those drivers, that they're not their employees, yet they have an Amazon van. They have the Amazon uniform.
Groups of workers at 7 locations in California, New York, Illinois, and Georgia went on strike. The Teamsters local unions put up picket lines at hundreds of Amazon facilities. And with all the recent sightings, the FAA has put out a video it says is helping people better identify drones.
Small airplanes typically have red and green wingtip lights, along with white strobe lights and a flashing red beacon.
This is for you, Paul. It explains how all aircraft, including drones, are required to have certain lights. Global news, 24 hours a day. Whenever you want it with Bloomberg News Now. I'm John Tucker, and this is Bloomberg. Jess and Paul.
Hey, John Tucker, thank you so much. We appreciate that. Jess, you're always writing something. What's the next piece coming out? Or what's your most recent piece?
Well, so I actually was looking at, there's a lot of conversations, especially heading into the Fed meeting about market breadth, right? Everyone wants to have the stats, but actually looking at through yesterday, 13 consecutive sessions through Wednesday, the longest streak of more decliners than advancers in the history of Bloomberg's data going back to 1996.
See? I ask a question, I get a great answer. She's always
writing
talking
up her own book, though.
I know it. It's funny how you do it.
I'm a reporter, though.
That's what I'm here for. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And this features report sponsored by IBKR. Markets never sleep, and neither does Interactive Brokers. Discover opportunities with CME Group futures across equity indices, interest rates, FX, energy, and more. Access CME futures around the clock at Interactive Brokers. All right, we've got stocks set to bounce back at the open after yesterday's sell-off. Came right after the Fed voted to lower interest rates again by 1/4 point. Also showed some caution over how fast they can continue to cut. NASDAQ futures up 0.6%, 145 points. Dow futures up 0.7%, 1%, 342 points, and S&P futures up 46. We have the 2-year yield at 4.31%, down 4 basis points. The yield on the 10-year, 4.54%, and that's up 2 basis points. The Bloomberg Dollar Spot Index is little changed. To earnings we go. We'll start with Conagra Brands. You know them. They make Slim Jims, Bird's Eye frozen vegetables. Their shares down 1%, lowered its full-year profit guidance. It pointed to higher than expected inflation, also exchange rates. Then we go from food on the shelves to dining out. Darden Restaurants, they own Ruth's Chris Steakhouse, among others. Their shares up 9%. Its full-year sales forecast beat estimates. And finally, to the used car market. We'll go to CarMax, and its shares are up about 8% after it beat quarterly earnings estimates. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That is a Bloomberg Business Flash. Paul and Jess.
All right, Lisa Mateo, thank you so much. We appreciate that. Jess Menton sitting in for Tom Keene. I'm Paul Sweeney. We are live here in our Bloomberg Interactive Broker Studio, and we are streaming live on YouTube as well. With the Fed action yesterday, how did the markets react? Well, the S&P traded off 2.95% yesterday. Big move. NASDAQ off 3.5%. On the S&P, this is on big volume too as well. 19 gainers yesterday, 483 decliners. That's breadth of selling. There was volume of selling associated with that. So the markets were a little surprised about kind of where the Fed thinks things are going here with their rate cuts. Let's check in with the professional, Phil Taves. He's the CEO of Taves Asset Management, joining us here in our Bloomberg Interactive Broker Studio. Phil, what did you make of yesterday's action, both with the Fed and then the market reaction to the Fed? How did you take it?
Well, the stock market has been just a bit bonkers. If you look at things like leveraged individual stock ETFs, leveraged triple Qs, 3X. So there's a lot of fluff in the markets, and I think it was just a surprise. People didn't expect the change in the dot plot to be what it was, and so as a result, we saw stocks sell off, and probably it was algo-driven. Frankly, if you look at yesterday's market move, I'm a little bit more worried about bonds. Hopefully stocks will bounce back. So far, as we've seen this morning, yields have not.
That's right. And to your point, I mean, if you're looking at the futures for the Dow Jones Industrial Average, ticking higher about 0.8% here. And that does come, and we've talked so much about this, the Dow was down for 10 consecutive sessions through yesterday. So that was its worst losing streak in more than 50 years. So I wanted to pick your brain on the positioning, because you're saying right now it looks like this is more of a bond story than maybe a stock story at the moment.
Yeah. So, here's a visual for you. You know that when you're doom scrolling and you see those houses falling into the ocean in the Outer Banks of North Carolina, I think those houses may be bonds, because what happens is if you have water streaming underneath, the sea level is higher. That's being created by things like debt. The fact that Bessent coming in as Treasury Secretary wants to bring the fiscal deficit down to 3%. I don't think he's going to get there. So you've got all of these fiscal, government debt challenges. And I think that creates a real headwind. If you look at bonds since the beginning of 2022, and you include inflation, we're down over 20%. So I don't know if people would think of bonds as being in a bear market, but we think they kind of are, and we're really worried coming into 2025 what that might look like.
What's the psychological level if you're thinking about the direction for the 10-year yield as well as the 2-year yield? Because right now the 10-year above 4.5% again for the first time since May.
Well, it's like looking into the sun to imagine the 10-year going back to 5%. But as we saw this week, we've seen some predictions for 6% 10-year yield. Yep. And so I think that people need to, bonds have been such a source of stability in the 60-40 portfolio for so long that people are sort of leaning back in their Barca-lounger of bond comfort when they think about it. But bonds, the truth is, they're an unreliable diversifier. And so you need to open your mind and not just go out and take duration right now. I think you should be adaptive. You should be reacting to trends, be in either T-bills, which could be the winning trade. The beginning of this year, I said it was the losing trade. It could be the winning trade, high yield bonds or investment grade, but be very sensitive to what we see over the next weeks in terms of yields.
And you were talking about
just a quick a red headline crossing the Bloomberg terminal. Trump would support abolishing the debt ceiling. This is according to NBC. So this was a key issue that we were just talking about with Francis Donald. We'll have more reporting on that.
And you were mentioning that some firms were making calls for 6% on the 10-year for 2025. So T. Rowe Price was one of them. Right. And then for 5%, you have Franklin Templeton, JP Morgan Asset Management, and a few others. So, I mean, what is the real probability in your mind as somebody who's managing money that we could potentially see something like that happen with a 10-year?
I think it's a decent sized probability. And the reason I do is that, our baseline right now, before you even start to consider consider any fiscal policy that has been thrown out there. And we all know what that is. Inflation, chasing people out of the country through deportations, you're already potentially moving up to 5%. Even if we just see a discontinuation of Fed easing, but the yield curve normalizing, there's a possibility that you could see that 10-year move higher. So we think 5% is not that improbable, and I think you need to open your minds and consider the possibility that we could move even higher than that.
Did your view of these markets, opportunities, risk, did it change the day after the election?
Yes, for me it did. So what we had with a Harris administration, if they would have been coming in, would have been much more a controlled range of possibilities in terms of at least on the fiscal debt side, right? So we probably discontinuation of Trump tax cuts, no tariffs being discussed really beyond what were already in place. So I think it made bonds look safer. We can go into stocks too then, because if you consider the possibility of that 5 or 10% on the 10-year, then you run into serious trouble in the stock market coming into 2025. So with stocks, I think there's a real desire to stay invested right now, and maybe that was just a one-day blip, but absolutely hedge it.
What about the long term when you're thinking about more the earnings expectations, not for even just 2025, but 2026 for the S&P 500? Because we have seen broadening out where obviously it's been driven by growth on the profit side for technology, communication services, discretionary that house those Mag 7 stocks. But then you're also starting to see that pick up, say in kind of the unloved type corners of the market the last few years, say healthcare, utilities, real estate, and other corners like that. As far as what drives stocks over the long term, like what does that picture tell us for the profit projections?
Well, two things. First of all, I think that I'm thinking more and more of the stock market as sort of like a speculative game, where it's just a question of how much longer we can see the bubble inflate, whether it stops now or whether it stops sometime in 2025. And so you need to think in terms of like a Ponzi scheme. I know that's not how people want to think of stocks, but I think ultimately it will turn lower. When that happens, a couple of things will play out. First of all, growth stocks will get clobbered, very likely. But then there's the possibility that value could look extremely good, right? If we see the market roll over. So there's a potential play here for people who have the willingness to actually allocate into something that's suffered for so long. But so hedge your growth stocks, absolutely, and do consider balancing out into more of a blend or value portfolio.
30 seconds. High yield and leverage loans have been the best performers in fixed income this year.
Yep.
Does that continue next year?
So I think high yield looks better than investment grade, in our opinion. And so if you can see the economy continue to increase, if let's say, I've been so pessimistic on yields today, but if you see the 10-year stay at this 4.5 level, then high yield bonds is the winning bet. So we think of the market in three ways, either T-bills, high yield bonds, or investment grade, and choose which one of those places you want to be and make that based primarily on the trends that you see evolving.
All right, Phil, thank you so much for joining us. Really appreciate it. Phil Taves, he is the CEO of Taves Asset Management, joining us here in our Bloomberg Interactive Broker studio. And again, the red headline, just crossing the Bloomberg terminal. This is according to NBC. Trump would support abolishing the debt ceiling. That was in a phone interview he had with NBC News, talking about this upcoming funding of the U.S. government. Again, apparently Friday, midnight. Is kind of a deadline. The Republicans, Speaker Johnson, thought he had a deal, but both Elon Musk and President-elect Trump have come out presumably against that deal, which raising the stakes that maybe there will be a shutdown of the government.
Right ahead of Christmas.
Right ahead of Christmas. So you can't write it out any stranger, I guess, but we've been in this place before. S&P futures up 48, Dow up 350, NASDAQ up 158 points. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo alongside Paul Sweeney and Jess Menton with your opening bell report. Well, after a rough day on Wall Street yesterday, it's a brand new trading day. So we also had some fresh economic data continue to show how robust the U.S. economy is. GDP increased at a 3.1% annualized rate in the third quarter. We are off and running, so let's get right to it. The S&P 500 up 0.7%, 43 points at 5,916. We have the Dow up 0.7%, 299 points at 42,602. And finally, the Nasdaq up nearly 1%, 177 points at 19,570. The two-year yield 4.31%, down 3 basis points. The yield on the 10-year 4.55%, and that's up 4 basis points. At the open, want to check in with Micron Technology. They are down 14%, and shares of Lennar down 7%. That is your Bloomberg opening bell report. Paul and Jess.
All right, Lisa Mateo, thank you so much. We appreciate that. Jess Menton sitting for Tom Keene. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Brokers studio. The headline that's kind of getting some attention here right now, President Trump saying that he would support abolishing the debt ceiling. That's according to NBC. So, of course, my question is, what is the debt ceiling and why do I care? And just as I asked that, our man Miles Miller in Bloomberg Television sent out a blast, an article on Bloomberg.
There you go.
Basically saying, here's the debt ceiling and here's what you need to know about it.
Everything you need to know. All your questions answered,
2
Paul.
minutes, I kind of doubled or tripled my knowledge, but I want to know why it's important politically. So that, we turn to David Gurr, Bloomberg Television. Hey, David, this is kind of a thing here. What's politically, what do you understand when you talk to your sources in Washington about this debt ceiling and why raising it is an issue?
So I've covered numerous debt limit shutdowns and showdowns, and what's really important to understand here, it's the legal limit on what Treasury can borrow to pay its existing bills. So we're not talking about any new spending here, and that's the thing you really have to underscore, is that there's been a lot of talk from President-elect Trump and his team about cutting spending, cutting government spending. This would have no effect on that, at least in the near term. What we're dealing with here is just paying the bills that are already due. So what we find ourselves in is a very strange predicament where Donald Trump is floating this now in a phone call, I gather, with NBC News. So it's one of these instances where we don't know how well thought out this is or how it might come to pass. But it comes at a time when we're at a really serious precipice. That is, this deadline for funding the government is just a few hours away. It seemed like House Speaker Mike Johnson had a deal in hand, a very long piece of legislation, 1,500 pages in length, with a lot tucked in there. That seemingly upset the president-elect, the vice president-elect, and Elon Musk, who is hanging around with them a lot as well. And we saw a flurry of tweets about what is in that bill, some things that aren't in that bill that he's kind of played up over the course of the day. And now we see Donald Trump taking a stance against that. So Republicans in the House in particular are in a real bind here because, again, the deadline looms, 12:01 a.m. tomorrow, so fewer than 24 hours to go, and they have to kind of cobble together something that's going to keep the lights on in Washington.
So when it comes to these suggestions, especially NBC News reporting that Trump would say potentially that he would support abolishing the debt ceiling, can they really abolish the debt ceiling?
You know, Congress could. They could change the mechanism by which the government pays its bills, and the U.S. is unique when you look at other developed nations in having this mechanism in place where Congress does have to authorize paying bills that are due. So I could see in kind of a broader look at the way the government spends and this effort perhaps by Elon Musk and Vivek Ramaswamy to kind of cut parts of the government. Maybe that could be part and parcel of the proposal that they put forward. But it is not, I just want to underscore here, this is nothing that could be accomplished here in the next 18, 24 hours. It's something that would take a lot of debate and negotiation by Congress.
You sat down face-to-face meeting earlier this morning, Secretary of State Antony Blinken. What was your key takeaway?
You know, he's somebody who is running to the finish line. He's not slowing down. I did an interview last week with Janet Yellen. It was much the same. There are things that both of these secretaries want to accomplish before they go. He is really traveling a ton, trying to see if he can get a ceasefire deal negotiated before he goes. But front of mind for me is what's happened in Syria over these last many weeks. Something that the Secretary of State often says is you deal with the world that you have, not the one that was, not the one that you wished you had as well. And so it was a real surprise that Assad lost power in Syria, and in that vacuum has emerged as the kind of de facto government a group that the U.S. regards as a terrorist group, and now the U.S. finds itself in a position of potentially supporting that group as it tries to build a government there in Syria, certainly negotiating or talking with them as well. And so my main takeaway is just how fluid the situation is there, and how when you look at the wider Middle East, this is just another flashpoint that's come about here over the course of his term. So he's had no shortage of fires to kind of try to put out over these last 4 years.
Right, and I heard that he's, again, they're going to be really working to the very last hour of the administration to try to get the hostages back. That was a takeaway for me. David, thank you so much for joining us. David Gura, correspondent for Bloomberg Television, host of The Big Take podcast, and we appreciate getting a few minutes of his time. Again, he had a wonderful interview with Secretary of State Antony Blinken just this morning here in our Bloomberg studios. You can go find that on the terminal and on Bloomberg.com. Let's turn back to these markets here. Again, we've got
rebound.
You've got a little bit
green
of a
on
rebound
the screen here.
Yeah, we had that big sell-off here. I'm going to get the correct screen up. The cash market, Lisa did get the markets open for it. We appreciate that. But we got the S&P, the Dow, and NASDAQ all up about 1%, retracing some of the losses yesterday. Joining us right now, Young Yu Ma, CIO at BMO Wealth Management. Young Yu, I'd love to get your thoughts here on kind of what we heard from the Federal Reserve yesterday, how the market responded to it yesterday, and maybe even the response to the response this morning.
Yeah, thanks, Paul. It's great to be here. Well, I think the Fed, if you read between the lines, kind of communicated that it's in a bit of a bind here, that in order to lower interest rates any further, it's going to have to see a string of favorable inflation data. And that's going to take some time to come by. And in the meantime, the labor market shows signs of cooling. So it's not as if the Fed can swiftly come to support that until it sees better inflation data. So I think the Fed is just on pause for a while for the foreseeable future. And the markets really didn't put a lot of credence in the idea that Chair Powell mentioned a few times that growth is strong. And at least today's GDP revision helped to reinforce that idea. And I think that's at least lifting some of the cloud that was over the markets yesterday.
And looking at the VIX, that was the third biggest expansion that we've seen in the last 11 years. But usually when we see big VIX spikes, they turn into buying opportunities if you look over the coming month, 3 months, 12 months, as you know. So what are you looking at? Because there was so much debate coming into this week, especially people would argue about valuations and how stretched that they were. But Sam Rowe, he was right about, he had a column earlier this week where he talked about, that's not really that great of a timing tool. So are you using any of this sell-off to add exposure or add exposure towards stocks for your clients?
Yeah, that's a great question, Jess. We do believe that in 2025, there will be more volatility than we've had in the past year. And a lot of that should present buying opportunities. We think productivity is going to come in quite strong in 2025 and help to lift profit margins, help to lift growth and sustain this rally that we've had amid the volatility that takes place. But the VIX spikes, yes, that does tend to lead to buying opportunities. But the thing is about that is where the thresholds are very difficult to determine. There used to be a kind of a rule of thumb by the VIX or by the market when the VIX goes to 30, but then there are times when it spikes to 50 or 60. So that's difficult for a timing tool as well. Valuation is probably even more difficult for a timing tool. But we don't see valuation here as a reason to stay out of the market. Tech plus the mega cap names that are in communication services or consumer discretionary are about 45% of the S&P 500 that really raises valuation overall for the marketplace. So we don't think valuations are so extreme that we're going to move based on that. We really want to move based on what we see as underlying fundamentals, which should be healthy in 2025. And the volatility that we see, whether it's from tariff moves or scares related to longer term interest rates or what may come, will probably present buying opportunities, but you have to be a bit patient here.
And just looking at the VIX, as Jess was mentioning, it did, we've been sitting around 15, 16, 17 for a long time. It spiked up to 27 yesterday. It's down 7 points today. We're sitting right at 20. And I know for a lot of folks, 20 is kind of a level that kind of gets your attention. Above 20, that suggests something about volatility in the market. Below 20 suggests something else in terms of people feeling a little bit more comfortable here. Young Yu, on the fixed income side here, how much credit risk are you suggesting clients take in 2025 here?
Yeah, credit risk is a tricky one here because credit spreads have compressed so far that the risk reward just doesn't look favorable. We don't see on the horizon a meaningful case for those credit spreads widening substantially and investors suffering losses, significant losses from widening credit spreads. But if you just look at where the opportunities are, you can clip coupons from higher yields in that marketplace, but we don't see a lot of prospect for capital gains from spreads tightening further. So what that means is we just think there are better opportunities elsewhere. We're not advocating a lot of credit exposure right here. We'd rather lean into U.S. equities more and get more of that upside potential rather than take on credit risk here. Because if there is a pullback or a downturn, that credit risk could be exposed. And we'd rather take risks where we see better upside potential.
Bank of America's fund manager survey earlier this week showed that cash levels fell to the lowest on record. Sometimes that can be used as contrarian indicators here. So who do you think's going to buy a potential dip if you're thinking about hedge funds, institutions versus retail traders? Because JP Morgan actually had a note out this week and they were talking about how retail traders actually are potentially posting their second weakest performance in any year when the index posted a positive return since 2015.
Yeah, I think that positioning, it's only really when you get to extremes where that positioning tends to matter much, whether it's very extreme cash buildup or very extreme cash drawdown. I think that's probably focused on a bit too much. I think that at the end of the day, the fundamentals are typically what's going to drive the market further. And, money tends to just flow through the system into different securities. And it's the aggressiveness with which it flows through the system that's going to determine whether or not prices rise or fall. So we're not putting a lot of credence to that. We think there is some level of enthusiasm in the short term in the marketplace. It could still deflate out a bit. But if we look at longer term measures of sentiment, which we have a proprietary measure of, we don't see this kind of excess positive sentiment here.
All right, Young Yu, thank you so much. We appreciate it. Young Yu Ma, CIO at BMO Wealth Management, giving us thoughts on these markets. With our news in New York City, John Tucker, sorry.
All right, Paul, just with a month to go before he returns to the White House, Donald Trump shaking up Washington again. He trashed House Speaker Mike Johnson's plan to avoid a government shutdown before the holidays and demanded debate on the debt ceiling now rather than after President Biden leaves office. Bloomberg government reporter Jack Fitzpatrick is following this drama from Washington.
It's a really remarkable thing to see this demand by the president-elect out of the blue, which he clearly had not communicated with any of the relevant players, saying, now I want a debt limit vote in the next couple of days. And I might even want you to eliminate the debt limit. Or his words were terminate the debt limit.
Well, as that drama unfolds, NBC is reporting Trump would support abolishing the debt ceiling. Ho, 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 oh no, just in time for the holiday rush, thousands of Amazon workers have walked up the job onto the picket line. According to the Teamsters Union, this includes about 10,000 Amazon workers at facilities all across the country, in New York, Skokie, Illinois, Atlanta, San Francisco, and Southern California. The big question for consumers with this action coming less than a week before Christmas and Hanukkah, are there going to be any delays shipping gifts purchased on Amazon? At this point, organizers have not said how long the strike is expected to last. And Luigi Mangione, the suspect in the fatal Midtown Manhattan shooting, the top United Health Group executive, could return to New York to face murder charges as soon as today. Mangione is telling a judge in Pennsylvania whether he's going to continue to fight extradition to New York. And Russian President Vladimir Putin holding his traditional year-end marathon news conference. Asked about President-elect Donald Trump, Putin said he is ready to talk.
I haven't spoken to him for more than 4 years now. I am prepared for that conversation at any time. I will be prepared to hold a meeting as well, if he so desires.
Speaking there through an interpreter, Putin, who's held power nearly a quarter century, has vowed to bring what he describes as the special military operation to a victorious end and boasted about Russia's battlefield gains this year against Ukraine. Global news 24 hours a day, whenever you want it, with Bloomberg News Now. I'm John Tucker, and this is Bloomberg. Paul and Jess.
All right, John Tucker, thank you so much. We appreciate it. Stocks holding on to the gains here. We've got the S&P 500 up at 0.9%. We'll have more coming up. This is Bloomberg. Good morning.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. We've got stocks in recovery mode after yesterday's sell-off. The Nasdaq up 0.8%, 170 points. The Dow up 0.8%, too, 353 points, and the S&P 500 up 52. The two-year yield 4.32%. That's down 3 basis points, and the yield on the 10-year 4.56%. That's up 4 basis points. To currencies, we have the Japanese yen down more than 1%. We have the pound down up about 0.1%, and the Bloomberg Dollar Spot Index is little changed. Bitcoin, which took a hit yesterday, now up about 0.5% at above 101,000. Few companies making news. That's iPhone maker Foxconn reportedly in talks with Renault to buy its Nissan shares. That's according to Taiwan's Central News Agency. And sources say Volkswagen, labor leaders moving closer to an agreement that would keep its German car plants open. And finally, the FDA says Eli Lilly's diabetes and weight loss drugs, Mounjaro, Zepbound, they are no longer in short supply. What that means is that compounding pharmacies, well, they have to stop making those copycats. That is a Bloomberg Business Flash. Paul and Jess.
All right, Lisa Mateo, thank you so much. We appreciate that. Jess Menton sitting in for Tom Keene. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Brokers studio. We're streaming live on YouTube as well. So head over to youtube.com, search Bloomberg Podcast, and that's where you'll find us. Arguably, the biggest investing theme over the past 2 years has been AI. What is it? And how do you get exposure to it as an equity investor? Is it some stuff more than just NVIDIA and some of these other technology companies? One of the areas that's getting some attention is energy. How do you power all these data centers? The S&P utility sector is up 19% year to date.
That's right, utilities.
Yeah, our next guest thinks about this stuff. Angie Gilday, ENR, regional co-lead for the Americas, but the consulting companies and accounting companies have the worst titles of any companies I've ever seen. Why can't you just be managing director or leader, whatever? KPMG US. I know the CEO of KPMG. I tell them this all the time. Angie, talk to us about how you guys think of the energy industry as a contributor, as a player in this evolution of artificial intelligence in this country.
Well, energy is a critical part of the evolution of AI. In fact, it's probably the #1 bottleneck that we're seeing right now in terms of being able to scale AI. So say our energy providers, our hyperscalers, and the tech companies.
So Paul was actually pointing out you are a fellow Texas A&M grad. I also graduated from there, and I know you are based in Houston, Texas. Something that I cover on the stock side specifically, and Paul and I have talked so much about this year, as well as Alex Steele's, when you look at these utility sector performance, especially data center type businesses, that sector alone, I mean, it's up close to 19% year to date, and a lot of the positioning data well ahead of the Federal Reserve once they finally started cutting rates back in September. You saw a lot of that front loaded there, but typically that's thought of as, when you're having a rate cutting cycle. But this was a big AI trade when it comes to this. Some of that's cooled off a little bit in the positioning, but how are you kind of view the direction when you're seeing things beyond kind of the Mag 7, the big tech stocks that are tied to AI versus other industries when you think about not just energy, but utilities?
Yeah, we're seeing a tremendous amount of activity going on between the data center companies and hyperscalers like the big tech and the utility companies, as well as traditional energy providers, all trying to secure reliable, big sources of energy to power these data centers. And they're running into some key challenges, one being just the availability and overall grid capacity to support the power that's needed. And also what type of energy source. One of the big things that we saw in our recent survey was tech is willing to pay more, up to 50% more, to secure reliable, clean energy. And I think that's a good, important point and potentially very valuable to the American retailer consumers of energy, because it could help offset some of the cost for clean energy.
Angie, when you talk to some of your tech clients and they're thinking about how to fuel these data centers, how committed are they to kind of green solutions versus just give me the lowest cost source of fuel?
Well, they're certainly committed to the green solutions. They've committed that to their shareholders. into the sentiment. And so what we're seeing is they are willing to pay more, but speed is important. And so there is opportunities for them to secure green power to provide a portion of that demand, but also natural gas plays a big role in this, because not only do you have to have reliable supply, but it's got to be redundant, and it's got to be available even on the hottest days in Texas and in the coldest days in the Northwest.
And the Washington Post actually was reporting this morning that President Biden was actually drafting a plan for construction of AI data centers on federal lands. When you think of the dynamic between a new incoming administration and also Trump potentially dismantling Biden's clean energy initiatives, how do you view kind of moving forward in the coming years the dynamic between competing forces?
Yeah, I think, there's certainly some things around regulatory and permitting that may change from one administration to the other. But the reality is, in order to give us the energy that we need, not only for data and AI centers, but also for the average American consumer, it's going to take all sources. So here in Texas, for instance, I'm seeing here in Houston, Texas, energy capital of the world, 30% of our power comes from renewables. So it's wind, yes, it's solar, yes, it's going to be natural gas. It's going to be a mosaic and a source of multiple energies.
So, Angie, you mentioned that you are based in Houston, Texas. And again, I'm a big viewer of Landman, so I now consider myself an expert on the energy patch out there in West Texas. Talk to us, what's the feeling in Houston these days? Because I know your economy is so diverse now versus maybe a generation ago and was maybe more dependent upon energy. But talk to us about the Houston economy, the energy industry, and others.
The Houston economy is very strong. I mean, we enjoy being a no state income tax state, so we attract a lot of businesses into the state of Texas. Houston's really diversified itself. Space is a huge component of our sector, as well as energy and healthcare. And so we're very bullish. The public sentiment's very bullish around energy. We know that energy demand's going up. We know that's not going to decrease anytime soon. And the question is, how fast does the energy transition happen? That's still up for the debate, and depending on administration, there could be starts and stops to that. But certainly, energy's not going to go away, and it is going to take all sources. So there will be decades of oil and gas required to power our country and our world.
When it comes to the race to scale AI infrastructure, what regions within the U.S. do you think are more adaptable in a position to do that versus others that might not be quite as strong in that position?
Well, I think there's a couple of things. One, land is a big component of the equation. So where can these tech companies find large swaths of land? Water is another component, and energy. Where can you get the energy? So what states with their regulatory environment are going to allow for the rapid deployment of the energy, and then fiber connectivity. So you see a lot of data centers in the Virginia, DC area, and that's because there's a good amount of fiber infrastructure. So there's multiple aspects that play in part to these data centers, but certainly I think it's an area where multiple states and regions of the world can certainly benefit.
Angie, thank you so much for joining us. Really appreciate getting a few minutes of your time. Angie Gilday, ENR Regional Co-Leader for Americas at KPMG-US. So the Aggies are playing in a bowl. We've confirmed that, right?
USC,
against
the Las
USC.
Vegas Bowl.
The Las Vegas Bowl. Okay, all right. So we'll get Aggie Nation. They'll travel. They'll go to Vegas, right?
Of course, always dedicated.
I mean, you graduate like a million kids a year, don't you? I mean, it's a huge school.
So it's actually the biggest public university in the U.S. There's over 70,000 students.
Wow.
Yeah.
In College
Station, Texas.
What is College Station like?
Oh, it's, a bubble of college fun. You're basically 18 to 22-year-olds. Obviously, you have people doing their masters and PhDs, but...
Where is College Station?
It's right in between Austin and Houston. It's 90 minutes between both, but they're in opposite directions.
Okay. All right, there you go. I can't say I've ever been there, but I bet you'd be fun.
We should go. Tom Keene wants to go. He always has the A&M bow tie on.
Yes, he does.
But he's wearing it today.
We'll do a remote broadcast from College Station. If ESPN Game Day can do it, I think we can.
Yes, that's right.
Like Surveillance Day, College Station, Texas. All right, we're going to have more coming up. This is Bloomberg. Good morning.